Ladies and gentlemen, distinguished policymakers, market leaders, investors, members of India's financial community, a very good evening. And a very warm welcome to India Bond Presents CNBC TV18 India Fixed Income Summit powered by Mirae Asset Mutual Fund. At a time when India stands at the cusp of unprecedented economic transformation, the fixed income market is emerging as one of the most powerful engines for driving stability, capital formation, and long-term growth. From government securities and corporate bonds to digital debt platforms and retail participation, India's debt markets are evolving rapidly, creating new opportunities for investors, institutions, and economy alike. And today we bring together some of the sharpest minds from the world of policy, banking, markets, fintech, and investment to decode the future of fixed income in India, the decade of all about how India is getting into a place where we are making the money, where we are also saving money, and where we are helping our populations and our businesses do well. First, I'd like to thank our partners for their support and for making this August gathering possible. Our presenting partner, India Bonds, of course, powered by partner Mirae Asset Mutual Fund, our associate partners, AK Capital Services, Nippon India Mutual Fund, National Bank for Financing, Infrastructure and Development, and our exchange partner, NSE. We are thrilled to announce our partnership with the Grow Billion Trees initiative. And as part of this effort to combat climate change, a tree will be planted in the name of each panelist participating today in our discussions. So together we can help create a greener future, one tree at a time. And before we head into a day filled with insightful discussions and panels, it is my pleasure to welcome someone whose voice has long been important in shaping the discourse around financial markets, the banking sector, money markets, and macroeconomic trends. Please put your hands together for CNBC TV18's Latha Venkatesh as she delivers the welcome address.
Thank you very much, Mugdha, for the very generous introduction. On behalf of CNBC TV18 and Network 18, I welcome all of you to what I would very much cherish, the India Fixed Income Summit. My sincere gratitude to Aditi and Vishal, the power behind the India Bonds team, which have made this Fixed Income Summit a reality. I sometimes want to rub my eyes to believe that it is really happening. And thank you very much, every one of you, to be part of this. I'll tell you why I want to rub my eyes, and Vishal will agree with me. I'm perhaps one of the oldest and maybe sometimes the only fixed income reporter in the country to have survived this long. We all of us in this room, fixed income heads, people like Suyash and company, people like Vishal and company, Mr. Mittal, who has been around for much longer in this field, all of us feel like stepchildren. I mean, fixed income is by far the more intelligent market, but a mix of taxation, a mix of pouring liquidity and murdering the yield curve, all this has made fixed income kind of crippled. We are always at the mercy of policy, when it should be actually in hand with policy to develop the country. It wasn't like this. When I joined the fixed income market in the mid-90s, we already had a developed fixed income. We already had a developed debenture market. I mean, I was just telling Mr. Mittal, don't you remember, sir? We used to have, actually, we could strip the coca. We could have debenture and the interest rate traded separately. It was at that level when the unfortunate Harshad Mehta episode and the intermediaries taking even the government security market for a ride led to the intermediaries itself getting decimated, and the rest is history. We saw equities march ahead and debt kind of becoming an also-ran market. But even if you remember, Suyash, up until 2021, if you looked at the AUM of mutual funds, which was higher, debt mutual fund or equity mutual fund? AUM of debt was always higher. And then came the tax blow. Indexation gone, interest rates raised to slab rate. You know, what is the slab rate? See, they tell you the slab rate is 33%. It's not really 33% because for HNIs, it would go to 40%. So here you have an equity mutual fund which will give you a capital gains tax of 12.5 and a debt which will tax you up to 40%. You would be a fool to go into debt. And then you saw from 2022 onwards, is it? Debt was growing, but equities was galloping. Today, even asset allocation of pensioners depends on tax, not on what your risk appetite should be. The reality has been skewed, I would say, by policy, but I take heart from the fact that just yesterday, the country's most important policy maker on financial matters, the finance minister, has acknowledged that they will take a look at capital gains tax. I don't know, maybe it's meant only for foreigners, I do not know, but I keep the faith. I keep the faith that debt will have a better chance in the days to come because its importance is realized. Debt encompassing, including, interest, fixed deposits of banks, including debt mutual funds, gilt funds, and the entire world of corporate debt is needed for infrastructure development, is needed for everything from bloody working capital all the way up to, the most long-term and largest capital projects that the country needs and needs financing for. So my hope is bright, and it is in this context that I want a round of applause for people like Vishal and Aditi, because this online platform has given, practically overnight, or maybe over a year or two, has given retail investors a chance to buy debt transparently. Until now, even that was a bit of a obstacle race. We at least are now able to buy, even if it's not quite RFQ, it's not as if you get quotes that get matched, but at least there is a reportage of the done deal. We are having some kind of an RFQ platforms available, and may their tribe increase. Perhaps a time will come when we will have something like quotes matched on the level of the equity markets itself. But it is a very good beginning that the online platforms have done, and we can only go from strength to strength from here on. That at least is my hope, my prayer, and my ardent wish. With that emotional outburst, let me welcome all of you once again. We have a string of excellent thematic discussions lined up for you, and absolutely the creme de la creme of the debt market and the fixed income market to speak to us. Spearheading this retinue of speakers is the SEBI's ED herself. Maninder Chiva is with us. Thank you very much for coming by, and thank you, Deena, as well. Your presence gives us the encouragement that policymakers are listening, and there will be more smaller, finer developments, technological developments to ensure that the debt market becomes as vigorous as it was in the past and more vigorous than the equities market is today. I wish all of you a useful evening of discussions, ideation, and hopefully a solid set of requests, asks to the policymakers. I wish you a happy evening. Thank you very much for coming once again.
Always such a pleasure to have Lata start the evening, and just the right note of energy, excitement for being in this room full of people who are going to make a difference. All right, as India's fixed income landscape continues to evolve, platforms that simply access, drive transparency, and encourage wider participation are playing a defining role in shaping the future of the bond markets. And leading that transformation are the visionaries behind India Bonds. It is now my pleasure to invite co-founders of India Bonds to deliver the opening address. Let us first put our hands together for Aditi Mittal, co-founder, India Bonds.
After that speech of Lata, I really don't know what to say. But I will definitely start with saying thank you very much. Debt has been the stepchild, has been the poor child. But the fact is, after so many years, and after 2 decades of my career in this market, I'm seeing a room full of people who are inquisitive to know what is debt market. I'm so glad to see all the market intermediaries to be present here to support this cause. And today my fear is, for the first time, the room could overflow. Actually, us and CNBC has been sweating about the idea, where are we going to make the people sit, which debt market has never witnessed before. So thank you very much, all of you. Good evening, and a very, 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 very warm welcome to our markets, a market which is the future of India, future of infrastructure, and the future that will make all of us wealthy and prosperous and will take us to Viksit Bharat. And a special thank you to the regulators for giving us the support to make this event a lot bigger successful. Thank you both the ma'ams for coming here. I've spent over 20 years in fixed income market. Yes, my father did not let me go into equity markets. He put me into the non-glamorous debt market, and I used to rack my head. I said, what am I doing here? However, today I think it's the right market. I should have been here, and I am very much here. I've spent 20 years in this fixed income market, and I've seen times when price discovery was only over the phone call. I'm sure सबके पास 5-5 phone होते थे और phone बचते रहते थे. It used to be the dealer market. Minimum ticket size was minimum 10 lakh rupees. 10 lakh होते थे, और उस समय की बात कर रही हूँ जब 10 lakh rupees used to be a very, very big sum of money. Bond market was a closed door world that worked mainly for institutions. What did bond market means? As a child, I would say, as a grown-up girl, when I was in 28, 29, if socially I would tell people, oh, I'm into capital markets, so they would say, beta, kaun sa equity अच्छा लग रहा है? नहीं uncle, मैं तो debt market में हूँ. तो बोलते थे पता नहीं bonds क्या चीज़ होती है. So it was primarily within the institution market. And retail bond market was an oxymoron. I don't think so any of us thought that fixed income investment meant anything beyond mutual fund debt instruments or the FD market. And because of the support of many, and as we are going to give out, how much have we progressed on the retail bond market? I started in this market when corporate bond markets were just a footnote to the Indian financial landscape. Today, it provides what? It provides to a company a credible alternate to bank financing. There are many issuers here, and which I would want to believe that they would agree that bank is not the only source. The bond market has given them the alternates, and at times in a very, very attractive pricing. For an investor, a reliable fixed income avenue. Today, as the time will progress, we will see more liquidity, but there is an avenue which is beyond a mutual fund debt instrument or just an FD. And for an economy, a mechanism to channelize the long-term savings into long-term capital. And today we are going to talk in various panels about infrastructure financing, and that has only been possible because of the bond market. Now I'm going to give out some numbers, and it's going to be very interesting. And while I was talking to Lata, I said, please hear my numbers carefully, because when I looked at these numbers, I was amazed myself. On a macro basis, India corporate bond accounts for only 15% of the GDP. So the numbers I'm going to talk is only 15% of the GDP. As of 31st March 2026, the size of Indian bond market stood at US $2.76 trillion. But in this, 77% is G-Secs and SDL. And only 23% is corporate bonds. And ideally, we have to reach a ratio of 50-50. So there's a long way to go. As on 30th April 2026, there are approximately 4.5 crore active DMAT accounts. We have Vijay with us in the audience, and he's going to be soon on the panel, and I'm sure we're going to ask questions around that. There are approximately 4.5 crore active DMAT accounts spread across 99% PIN codes of our country. 99%. But this is only 5% of our population. For what population we have? Guess how many of them has corporate bond in their DMAT accounts today? Only 5.5 lakh accounts, which is only 1.25% of the DMAT accounts. So corporate bond first has to reach every demat account, and every demat account has to reach to every Indian. That is what is our journey. In this 4.5 crores, in this 5.5 lakh demat accounts, guess how many corporate bonds are there, or how much value of the corporate bonds? Only 57 lakh crore, where we are talking about a market which is $2.76 trillion, where we are talking about only 57 lakh crore, which is only 14% of the equity market. So to what Lata said, equity markets have grown with gallops. We are a tortoise, but we are a tortoise which will win the race, is what I'm going to say. So another interesting fact. In financial year 25-26, corporate bonds worth 11 lakh crores were issued. And I'm sure everybody sitting in this audience, including me, thought this 11 lakh crores are primarily PSU driven. I'm sure most of you will agree with me. And the answer is no. It wasn't. Out of 11 lakh crores, only 3 lakh crores, only 30% of the market was PSU driven. 8 lakh crores was private issuers. So the market is tilting. And there we are at the point of cusp, whereby, yes, our PSUs are important. They have raised resources from the bond market. The private sector is dominating now. And in this 8 lakh crore, our natural instinct is, सारी NBFCs होंगी, housing finance होगी, तो इसमें बड़ी बात क्या है? No, my dear friends. Out of 8 lakh crores, NBFCs were only 4.5 lakh crores, which is little above 50%. So when we talk about issuer diversification, it has happened in financial year 25-26 for private sector. And this is just the tip of the iceberg. We've spoken about the primary issuance. The favorite topic for all of us is liquidity. Those numbers are also very interesting, and I will take the attention of my MIIs here, market intermediaries here, that all because of you guys, we've reached that, we've not reached the threshold, but we are beginning to walk, not even run. So this is where the opportunity lies. In financial year 25-26, 28 lakh transactions aggregating to 21 lakh crore were executed on corporate bonds on stock exchanges. This works out to be 11,000 transactions on daily basis, working a daily turnover of approximately rupees 8,400 crores. And day is not going to be far when this 8,400 is going to be how much? A lakh crore plus? Is it a possible? Is it a dream? Somebody needs to pinch me? I don't think so. From where we have come to where we are. So numbers simply suggest that the market today is democratizing and witnessing participation from non-institutional investors, smaller investors in dramatically large numbers. SEBI's ticket reforms, gradually reducing face value from rupees 10 lakhs to 10,000, has been a complete boom, and we would like to thank both the ladies here and all the people back into the SEBI office. The presence of more than 40 registered online bond platform providers is clearly showing up a measurable results. Me and Vishal could be a channel for the OBPPs, but we are very thankful to every entrepreneur who has ventured into to put up a online bond platform, because it was again considered not to be a very, very viable or a very valuation-heavy measure, but we all are proving it wrong. We are going to be there, and we are going to give equity a run. And this did not happen by chance. All this and nothing has happened by chance. It happened because the regulatory architecture was built carefully and deliberately. The OBP framework forced pricing transparency and standardized disclosures. The work done across the regulators, exchanges, depositories, clearing corporation, and the broader market infrastructure has created the condition for this kind of acceleration. And we are very thankful to each one of you to be present today on the panel so that audience can understand how much work is going behind the numbers that we are talking about today. Every institution in this room has contributed to building what is now one of the most consequential capital market in the world. I would like to bring an attention to the fact electronic bidding platform. A lot of people are used to this word, and some of you who are not. Today, Indian primary capital market, debt capital market, is the most transparent way, because there is nowhere across the world where the book building happens electronically, transparently, and the price discovery happens on the platform. And it's all because of our exchanges and our regulators. So all the regulations that has come into play has been put in very carefully and deliberately to take care of the investor interest and to deepen the market participation. So again, on behalf of all of us, we are very, very thankful to you. We should get ready to witness a similar disruption in the debt capital market as we have seen in the equity capital market. It's an opportunity knocking on the door of each one of you who's sitting in the room today. There is an opportunity, and an opportunity which can be massively big. Given the reforms, the market has definitely grown in terms of issuer composition as well as investor base, which is what we have spoken and witnessed in terms of the numbers. An enabling regulatory framework and a digital access have fundamentally changed the scope of the eligible investors. The honest acknowledgement is simply this: the infrastructure has been built. Now the task is to deepen it, to make the secondary market more accessible across broader range of instruments, to bring more issuers to the public market, and to continue the work of bringing the non-institutional investors fully into this ecosystem. These are not gaps. These are our milestones. These are our next, I would say, the next targets that we need to achieve. And the collaboration required to reach them is exactly what this forum is seeking for today, here in this room, to achieve. India's bond market is not at its ceiling. We are not at the end of the story, my friends. But we are somewhere in the middle. I'm not going to say the beginning. I have my father sitting in the same room. I have Lata sitting in the same room. They're going to kill me if you're going to say you're still at the beginning. We're somewhere in the middle, but at the early middle. And with that middle, I would say that it's not the end of the story, and I firmly believe that the second half is going to be very, very exciting and very, very prosperous. Thank you, everyone. I hope you enjoyed today's event.
Thank you, Aditi. Very passionately you've put up your case. And the evening we shall look forward to all the discussions that are lined up for all of you. And now please put your hands together for Vishal Goenka, co-founder, India Bonds. Welcome.
So I'm the diversity candidate. You have two powerful women speak before me, and a powerful woman in fixed income speak after me. So a big hand for all the women in power and fixed income. Since my 25 years in global markets, in finance, there were always two topics which would empty a room: taxation and bonds. Today it's unusual, and it's something unusual going on because I see a room which is pretty full. And after all those numbers, very little to say. For decades, bonds and fixed income largely remained in the background of financial conversations. Equity markets captured imagination, headlines, distribution, technology, innovation, retail participation. Meanwhile, India's debt market became enormous, a $2.76 trillion market. And now suddenly something is changing. You can buy a bond in 5 minutes lying on the beach on your holiday. For most Indians, bonds were invisible, not because bonds did not exist, but India already has a multi-trillion bond market. It was because people don't know how to access. And people were already investors through our insurance and pension that we pay. For the FDs that we do, we are already fixed income investors. The issue was never demand for fixed income. The issue was the market architecture. Every major financial innovation in the country actually starts with infrastructure before products. Think the India stack: Aadhaar, UPI, mobile penetration, digital KYC, API infrastructure, and online investing behavior. With infrastructure comes the trust layer for the masses. And we're very thankful to our regulators, our exchanges, our clearing corporations, our trustees, for rapidly establishing that infrastructure to build the trust in the bond market. I always say fixed income is the last bastion of finance to be conquered by technology. But technology is not replacing fixed income expertise. It's merely translating the language of bonds to the common man. At India Bonds, we always believed that deepening the bond market is not just a financial market aspiration. It is a national necessity for economic growth. If India were to do a $7 to $8 trillion bond market, capital is not going to come only from equity or the banking system. Infrastructure needs long-term capital. Companies need diversified source of funding. Individuals need asset allocation. Household needs more than traditional avenues. A mature economy needs a mature debt market. Last 20 years, we've built democratization of consumption in the country. Apps, food. I think the next 20 years, we'll build democratization of capital, where the capital from institutions and individuals will chase the most efficient return and easy access. There are 5 things which I envision would likely to happen. Bonds became standard retail allocation. Products like bond SIPs, bond case becomes normalized fixed income investing. Fixed income intelligence becomes native mobile. India creates the largest global bond retail market in the world and relies on domestic capital investment rather than only global investment. Education, content, media becomes infrastructure itself, much like our humble Bond Street effort with CNBC. Our simple effort for Summit today was to bring together stakeholders of fixed income, to have serious discussion in the future of fixed income, to interact with leaders here and to learn. We are deeply grateful to all our regulators, institutions, issuers, sponsors who have agreed to participate today and tell us something more that they know. I genuinely believe that when we look back a decade later, we will say the golden phase of fixed income started here and now. But importantly, the agents of change today will not only be on stage. Each one of us in the audience is actually a believer and ambassador of fixed income. Let's explain to our grandparents, our parents, our children, our friends what a bond is. Let's be proud of our industry and build awareness across all the ecosystem and be proud of what we do. Let them tell कि अगर आप equity हो, तो मैं भी bond हूँ. Thank you everyone for joining us today. Like we say in India Bonds, a bond in every hand.
Thank you so much for that "मैं भी हूँ" bond message for the evening. All right, let's move on. As India's financial markets continue to deepen and mature, the development of a robust and inclusive bond market remains central to the country's long-term growth story, as we have heard from the last 2 addresses. And from improving market participation and liquidity to strengthening transparency and investor confidence, the next phase of reform will play a critical role in shaping the future of fixed income in India. To share his perspective on this evolving landscape, we now move to our keynote address titled Architecting Bharat's Bond Market, the Next Wave of Growth and Reforms. To deliver this address, please put your hands together for Mr. Maninder Cheema, Executive Director, SEBI. I'm so sorry, Ms. Maninder Cheema. Mr. Madam.
We start on a lighter note, and I must share that this is a, should I say, constant the scenario I face. There are pluses and minuses. I'm always presumed to be a man. In absence of my physical presence, it's a big plus. Considering that for long this world has been a man's world, so I have advantages of both sides. So I don't mind at all when people call me Mr. Maninder. After the very impassioned speeches by Lata and Aditi, and also the strong projection for future by Vishal. Okay, thanks. So I think it's my job as regulator to bring a little bit of sobriety. I will try and keep it a little interesting by narrating a couple of stories along the way. So, distinguished representatives from, and let me acknowledge, I think I cover everyone when I say the stock exchanges, depositories, clearing corporations. Do we have debenture trustees here? Okay, maybe. Rating agencies, corporate issuers, online bond platforms, wealth managers, institutional investors, and most important, our friends from the media. So a very good afternoon, and it gives me great pleasure and privilege to address all of you at this India Fixed Income Summit. I want to thank Lata for going back all the way to the time when we had an active bond market. And then something happened which took away all the trust in the people who were part of this market. And I want to, when I conclude my speech, come back to this point. But just keep in mind how important trust is. And if trust goes, how long-lasting the damage is. So we have had to start absolutely from a blank slate. We have had to start afresh in bond markets because of what happened in the early 90s. So now, this summit is signaling that our bond market no longer remains a niche conversation, and that we are now central to the country's financial infrastructure, investor protection, and growth strategies. Now our agenda is to architect a bond market that is deep, liquid, transparent, inclusive, and globally credible, and worthy of a Viksit Bharat to 2047. To become a developed economy by 2047, in addition to bank credit and equity, we definitely need long-term capital for infrastructure, for manufacturing, for energy transition, for urban development, housing, logistics, data centers, and innovation. While equity finances aspiration and risk-taking, banks finance enterprise, bond markets will finance scale, and Bharat now needs scale. Numbers tell different stories, and you have heard the numbers before. So in SEBI, we always look at our page on corporate bond markets and see how the graph is growing. And the numbers we watch are the outstanding numbers, outstanding corporate bonds. So we see a 7.5 trillion in 2014-15 to 59 trillion in 25-26, and we see a positive story, although it is small as a percentage of the GDP. We feel very encouraged to see fresh issuances of 9 to 10 lakh crores every year happening now. And again, the story which numbers tell. So I looked at corporates and NBFCs as being private issuers, 61% of the market. HFCs around 6%, PSUs 20%, and banks 13%. So the market architecture has transformed over the years. And here I want to narrate a story. I was handling corporate bond markets from 2009 to 12. And the one thing I noticed at that time was the fact that it's largely privately placed, very non-transparent, and OTC. And the only trading which happened was on public issues which are listed on exchanges. So this question remained with us on what do we do about the OTC market? And we had a visit to New York for some reason. And I took the chance to, we got in touch with some of the bond trading platforms in US. I visited 2 of them, I and my colleague. We had extensive discussions with what is it that makes the US bond market so successful. This was somewhere around 2010. From that came the idea of, and the one thing I extracted out of those meetings was that don't try to equate or bring bond markets to exchange-traded markets on an anonymous platform on a DVP3 basis. All that they are doing is translate OTC to an electronic platform. So that was the generation of SEBI trying to push both EBP as well as the RFQ platform. And slowly over the years, we conceptualized and came up with the framework for the RFQ platform. It's taken more than 10 years. I have come back into the same role at a different level after 2012 to 25, 13 years. And I find RFQ platform is there, but still contributing only 30% to the total volumes. So here's a challenge for all the people in this market. Why is RFQ still only 30%? And here's a task we have set for ourselves, and let's see how far we succeed as regulators. Why RFQ platform should become more than just a reporting platform. It should become more efficient, and we invite any suggestions, any inputs from anyone who feels they can add to how it works, on what are the improvements we need to make. Why is it that still people are preferring OTC? And how is it that we increase price discovery using the RFQ platform? If the market has better suggestions, SEBI is very open to looking at it. But it's taken more than 10 years to reach to a place where we are just 30% on the RFQ. And let me tell you another story about the OBPPs. So our legal structure, there is a constraint. We cannot legally allow an online trading platform to exist unless it is registered as an exchange. OBPPs are online bond platforms, but the legal architecture has remained within the boundaries of the SCRA. So OBPPs are aggregating orders, and the trade continues to be executed on the RFQ platform. So this RFQ platform has come in and enabled OBPPs to exist because our legal structure still does not recognize electronic trade matching platforms. You have to register as an exchange for that. There is also an issue we see about, so we have been trying to understand the function which OBPPs do, and as regulators, a matter of concern which I have flagged otherwise also. The price formation is happening on RFQ, primarily on NDS-OM from GSECs, and you derive your prices from there on RFQ platform. And the OBPPs are literally offering just one price. You are not letting the investor discover the price. It's a working, if my understanding is incorrect, I'm happy to be corrected. But this is something which needs more work. So we need to work more on more efficient and transparent price formation on in the bond markets, whether RFQ or any other platform which technology brings us going forward. SEBI also launched Bond Central, a centralized database which strengthens information architecture in bond markets. So pricing again is a function of information availability in bond markets. And something which we continuously work on. My sense is even today, there is incomplete information available on all bonds available for trading. So markets will become deep only when information is standardized, accessible, and trusted. Now, liquidity brings confidence to enter and exit the markets without undue price impact. And the assurance that the bonds are priced on fundamentals. Secondary markets give the comfort that people can exit in times of stress at a reasonable price. In this context, the budget announcement of 26-27 was very timely for having a market-making framework, along with announcement for derivatives on credit derivatives as well as total return swaps. So the budget tried to give an integrated reform agenda for corporate bond markets, covering aspects of both risk management as well as deepening of markets. SEBI has initiated work on the market-making framework. As we see it, the key building blocks for market-making framework are large, well-capitalized players with a strong balance sheet, because our understanding is that you cannot perform a market-making function without having a strong balance sheet. Now, these could be brokers, these could be banks and PDs, these could potentially also be merchant bankers. So we are looking at a framework where we can enable well-capitalized entities to play the role of corporate bond market makers. They would need to be able to hold significant inventory, hence the need for large balance sheet. They would need access to funding, and hence a review of the bank lending framework for corporate bond market players, as well as making the repo market more active and accessible. So these are the fundamental building blocks for a market-making framework. A lot of work needs to happen on all of these areas. A market maker would not succeed without adequate incentives for the capital risk, for the funding risk, and for the mark-to-market risk that they take. So we need to be able to figure out what sort of a viable commercial model can be put in place for market making. Again, SEBI is working on it, and if good suggestions come out of the discussions today, we are happy to take note of all these suggestions. Market making also normally requires some obligations on quote sizes, spreads, and quote presence during trading hours. Again, these are things we are looking at, and we are happy to take any suggestions which emerge out of this summit. Online bond platforms have expanded access and made bonds accessible to retail investors. The numbers have already been shared, so I don't want to repeat the numbers, but yes, we are looking at how we can add a distribution framework for online bond platforms. It's a regulatory challenge for us on how a product which is a secondary market product and which should normally be, when compared to equity, sold in a certain way, how to bring it into a distribution framework. It's not an easy solution, we are working on it, but that's one of the agendas which hopefully would see some light within this year. We also hope that credit derivatives would become active soon. So one of the issues which impacts bond market development is that it's regulated jointly by RBI and SEBI, and it needs a lot of coordination by SEBI along with RBI, and also recognition of the fact that the goals of the two regulators may be different at different points of time. And so within all these limitations and constraints, we still have work to do on bond derivatives, and total return swaps is also mostly an OTC product. Again, we are happy to work with market participants on how it would help as far as the exchange traded markets are concerned. A deeper market also requires a wider issuer base. So we need more mid-sized corporates, we need more green finance issuers. We already have REITs, InvITs, but we need more REITs and InvITs coming in as bond issuers. We are also encouraging of securitization vehicles, to expand the issuer base for corporate bonds. SEBI launched a Pan-India Bond Issuer Outreach Program on February 4, 2026 with the tagline, Bonds Ek Sashakt Bandhan. OBPPs have a strong role to play over here. The tagline brings out how bonds become a bridge between India's savers and India's long-term financing needs. And with the aim of carrying out multiple such programs, SEBI has planned to carry out many such programs during this year. One program was organized yesterday itself in SEBI Bhavan. Moving forward, technology has transformed securities markets hugely over the last at least 2 decades and is now an integral part of financial markets. Tokenization of securities is the next frontier, and bonds have been successfully issued in tokenized form in several jurisdictions. SEBI is planning a pilot program for issuing tokenized bonds. As there is a sense that tokenization offers several advantages which could potentially address the challenges faced in bond market trading, such as it will offer instant settlement, it will offer enhanced transparency, smart contracts, potentially increased liquidity by way of enabling anonymization, which today is not possible on the RFQ platform. So to sum up, there are a lot of exciting moves happening in bond markets, some of which will strengthen and deepen existing measures and some which are completely new, but will offer new solutions to old problems. So we look forward to more primary issuances through EBP. Here I want to say that we recognize that bond market is 99% privately placed. We recognize the fact that OBPPs are the channel which take this private placement down to the retail investors. It's a model which is very different from what has happened in the equity markets. We recognize this model. And in this context are the concerns on pricing. So those need to be addressed. We look forward to more trading volumes in secondary market transparency through the RFQ platform. We look forward to more liquidity through market makers, better funding through a more more active repo market, risk management through derivatives, retail access through OBPPs, issuer expansion through outreach programs, and investor confidence through disclosure, surveillance, and enforcement. Here I want to go back to the idea of trust. A bond market is ultimately a market of trust, a promise of payment, truthful disclosure, fair markets, vigilant regulation, and reliable exit. SEBI's role is to protect that promise, but no regulator can build this market alone. Trust has to come from the players in the market. We can watch, we can act after trust is broken. Trust must not be broken, because after trust is broken, it is already too late. So every stakeholder, issuers, intermediaries, market makers, platforms, trustees, rating agencies, investors, exchanges, depositories, all of them must play their part with discipline and integrity. Let this summit mark the shift from discussion to decisive action. A vibrant, liquid, transparent, and trusted bond market will finance our ambitions, lower the cost of capital, protect investors, and power the rise of Viksit Bharat. Thank you.
Requesting you to please stay back for a moment. Lata, may I have you on stage for the Grow Billion Trees certificate? Thank you. Thank you, Ms. Maninder Chima. Names may occasionally cause confusion, but your perspective today was crystal clear. Thank you so much. Thank you. All right, ladies and gentlemen, I have made 2 errors for the day. I'm going to avoid making a hat trick. Thank you. All right. As India's bond markets evolve, technology is becoming far more than an enabler. It is emerging as the very infrastructure accelerating access, efficiency, transparency, and scale across the ecosystem. And to explore how innovation and tech can deepen and strengthen the country's bond markets, may I invite our panelists. But first, Lata, can I have you back on stage, please? Put your hands together for Lata Venkatesh and our panelists, Vijay Chandok, Managing Director, N18L, Vijay Krishnamurthy, MD and CEO, India Inc., Vikram Kothari, MD and CEO, NSE Clearing, and Sri Ramakrishnan, Chief Business Development Officer, National Stock Exchange. Welcome, gentlemen.
We are missing Sri Ramakrishnan, but I think he will join us shortly. Okay, thank you very much, Mugdha. We are just waiting for Sri Ramakrishnan, and as soon as he's here, Chaya, if you can lead him to the stage. Okay, well, I just wanted to start by thanking Maninder Cheema. I think we know about Maninder Singh as a superb left-arm slow spin. This is ambidextrous in the way she spun it to her advantage. Thank you very much, Ms. Cheema, and it was also a very, very encouraging conversation. Let us hope the industry comes to the expectations of the regulators. But more importantly, we know from 1991 that laws have held us back. And when those laws were cut loose, we saw how India never looked back from the Hindu rate of growth of 3.5%. We went on to 5.5% in the 90s, to nearly 8% in the 2000s. And thereafter, it has been dilly-dallying between 6 and 8%, but certainly so far above the Hindu rate of growth. So a change in laws and regulations can make a world of difference. And that is what it has done to this panel. The representatives over here, NSE, NSE's Clearing Corporation, NSDL, and INX. Welcome, Sriram. Well, we know that there are these emergencies. Well, INX taking perhaps Indian bond markets to even more greener terrain. We have all those people who have given us a platform and who have leveraged the technology to ensure that the bond markets are as transparent, as quick as the equity markets, and that is where I'm going to start. Vijay, with you actually. Do you think that, okay, first tell us the measure. You've seen from your ICICI days and thereafter at NSDL as well, the growth of debt markets after a slow start. Tell us the positive side. How good has it been since you took over? And what are the latest figures in terms of improved debt market participation?
Yes, thank you first and foremost, Lata. Thank you, CNBC team. Thank you, the India Bonds team, for having me on this. Totally my privilege to be here. Like Lata, like you said, watched this market somewhat closely, somewhat from a distance for a long time. And from times, I would call it immemorial, we've been talking about the importance of bond markets and how critical it is for the economy and how important it is for it to scale up and how much we have to do to deepen it. Honestly, I think in the earlier part of this session, Aditi did mention that we are in the early middle kind of a time frame. I would kind of concur with that because particularly from the last 3-4 years, I think the starting point in some measure was the regulation enablement coming from SEBI, the OBPP sort of framework that came. We've seen the bond market finally widen to attract more retail investors. Today we have more than 40 OBPP platforms, which is very heartening. We've started seeing number of account newcomers coming to the
Those are the
debt
numbers I
markets.
want from you. What do you see in terms of...
So I'm coming to that, yeah. So those have started increasing. We have a total stock. Somebody mentioned 5.5. Those are active demat accounts. But if you look at the total stock of people who have opened, it's about 15 lakhs approximately. We are opening somewhere in the ballpark of about 70 to 90,000 on a monthly basis, new accounts, which is very heartening because if we had this conference maybe 3-4 quarters back, this number was approximately 50-60% of that number. So in the last 2-3 quarters itself, we've seen some scale up, maybe 4 quarters, 3 to 4 quarters, we've seen some scale up. So I clearly, and when we talk to people who are in this business, the OBPP business, we hear a lot of excitement. The numbers they talk of is not 30% growth, 20% growth. They talk of 4x, 3x in a year's time. So the excitement is palpable, and I can completely relate to the emphatic future projections that both Vishal and Aditi spoke about. Similar numbers are coming from, similar sentiment is coming from others. So I think from a positive point of view, knowledge is improving, access is improved. I think the whole infrastructure setup of behind the OBPPs has started improving. Technology has improved access. The most important factor, apart from regulation, technology, access, is trust. People, I can clearly see finally some element of trust because things are becoming more real time. He's able to see his portfolio. He's able to, to some extent liquidate. He gets quotes on a regular basis. It is becoming more equity-like, which has led to so much of growth. So I think on a positive note, he gets quotes on a regular basis. It is becoming more equity-like, which has led to so much of growth. So I think on a positive note, early, mid-morning kind of session. Where we stand.
I don't want to throw cold water on your numbers, but since you said that it is the last 3 or 4 quarters that you have seen the daily...
I would say from 2022-23 onwards, the journey has started, but it is regularly accelerating.
You're taking away my joke. Okay, my point is that in the last 3 or 4 quarters, the equity Nifty index is 10% lower compared to 4 quarters ago. And that may perhaps explain why the number of demat accounts in bonds have gone up by about 50%. From whatever, 5,000-6,000 numbers to about 10,000. I mean, I'm just guessing that one of the reasons why bonds become interesting is when some rival instrument isn't giving you the returns that they would once give. But Vikram, since as clearing corp, you would be the last word in terms of telling us whether the technology is finally full and complete. Would you say it is now as frictionless a market as in equities? Or do some one or two things remain to be done?
So, Lata, I think at NSE we've always believed technology is not an impediment, and somebody used the words enabler. I think that's what it has been over the last 3 years. From the way the structure is there currently, and the way we've been growing and we've been handling the volumes and transactions, as well as agile in terms of integrating the retail OBP platforms, I think it's there. It's all about scalability right now because the way we've seen the volumes grow, specifically if you look at the last 2 years of post-OBPP era, where now on an average we see around 7,000 trades daily, and at peak we've handled around 31,000 trades. And we would firmly like to believe that our capacities currently is to handle at least more than 2 times of what we are. But in the next 1 year, from a technology perspective, what we aspire is that at least from the peak that we've seen, we should have a 5 times capability in maybe say the next 6 to 8 months, because the way Aditi keeps pressing on the kind of growth, and we've started seeing that growth actually, is phenomenal. 2 years back, on an average, we used to have around 500 maximum daily trades. Now on an average, about 7,000 at NSE clearing, out of which 95% coming through RFQ, is a phenomenal amount of growth.
In terms of time, clearing, is the end-to-end absolutely frictionless?
It's fairly
or do you
very
think
smooth.
there's something that technology has still to deliver?
I think the way we've integrated over the last couple of years the entire technology stack, including UPI framework, let it be RTGS, NEFT of RBI, it's a seamless process now where an OBPP platform allows an investor to actually transfer the funds, us to reconcile, and maybe maximum, I think Vishal, you mentioned 5 minutes, but I think it may be even lesser than that when an investor is able to. And the biggest benefit is we are people equated to equity galloping, but I think it's the corporate bond market where the settlement is continuous. It can happen trade by trade once you get the other side, whereas in equity you have to wait for the next day for the settlement to happen. Technology, I think, is firmly there. The bed is out there, and I think now we are waiting for that distribution framework which will take the volumes up, and we'll have the capability.
Okay, I'm waiting for something else, and let me ask Srirab that. It is still a AA plus market, AAA and AA plus market. Do you think, what holds back to bring it down below that? After all, in equities, you have the entire range of companies. Even those reporting losses and negatives for years are still traded. So what would you say is the missing link to get at least to A and BBB plus?
See, if you look at this space from an outsider's perspective, as in you compare the rest of the world with India, there's one thing that strikes you. There's no requirement for credit rating in the US. There's no requirement for credit rating if you want to list your bonds in the UK. There's no requirement in Hong Kong, Singapore, Japan. But we've had always this requirement that if you want to list your bonds, you need to go through a credit rating. Now, I'm not saying this is the reason why smaller companies
exactly
are
the
not
point.
coming through.
I mean, it is because there is a rating requirement that at least you have so many. Perhaps if you said unrated people come, do you think that is going to increase participation in liquidity, or will it actually deter because you're not even sure? That,
no, so I'm looking at it in another way, which is that the psyche of the investor in India has got tuned towards the credit rating, and therefore, without credit rating, oh no, this could be risky. That's how people look at bonds in general. Whereas in the US, companies are heavily encouraged to go and list their bonds. Don't worry about the banks. The banks are there for short-term lending. Bonds is where you need to get your long-term money. That's how the inherent nature of the beast is. So therefore, I think we missed a trick somewhere by insisting on credit rating. Last year, I looked at some other markets as well. Russia, for example, no credit rating requirement. So I think the psyche of the investor is one factor to take into account. Secondly, I think we've never allowed the retail to face off with the institutional clients for some reason. The corporate bond trading always seems to be happening amongst the institutional players, and the retail is simply kept out. Only now in the recent couple of years, we've seen the OBPP slowly coming in and explaining what these corporate bonds and the debt-focused instruments can bring to a portfolio. So that's the other aspect that we probably need to look at. Thirdly, I think we need to think about how technology can make this happen, all of this happen, and make it very seamless. Because investing in bonds looks like very threatening. You look at a company, they have so many issuances. It's not like equity where you go buy Infosys, that's it. There's just one icing. So this concept of investing in bonds itself is not seen as so easy to do. You might make a mistake, you might choose the wrong bond. That's the kind of complexity. Therefore, even the RFQ platform, although it's a great initiative, it's still struggling. It's still being used like a reporting platform, and not really a platform that should get better deals for an issuer of bonds.
So, Lata, if I may, just add a little bit more to your specific point.
Are you sure that this is a rating requirement issue?
Yeah. So let me tell you what we've observed in the last couple of years, more recently actually. We saw the numbers of corporate bonds outstanding. That's about approximately, let's say, 55 lakh crore. 97% of that is AA and above. So you're right in saying that we have gravitated. But if you look at why it has been AA, it is largely dominated by the penchant of the institutional investors in the historical past. And that's been gravitated towards the AAA, AA plus kind of a family. But as retail has started improving in the last few years, we've started seeing a very interesting trend. In 2025, FI gives a very interesting outlook to what could potentially hold as a trend going forward. Out of the total issuances that happened, 16% were AA and below AA actually, which means on stock.
Come again with that number?
Sorry?
Come again, number?
16%. 97% is AA for stock, but new issuances may 16% is coming below AA.
Below AA, okay.
Which means if this continues over a period of time, I think the demand, which means that clearly the
and they come without any credit enhancement, first loss,
so
nothing?
they are actually below, so all included. See,
all
credit
included,
finally
it's below
comes
AA.
below AA. And one of the reasons is because I think in the thirst for yield, the retail investor is looking for those kind of instruments. While this is something which is an interesting trend, I think as responsible market intermediaries and infrastructure players, we have to be careful to educate the investors that there is a risk associated with that as well. So I think that apart, I think as a trend wise, one can really expect more participation coming as retail increases in the below AA family.
Absolutely. That's extremely encouraging to know that. I would assume that investors are coming with their eyes wide open. Institutions have a mandate, for instance, insurance companies or pension funds. They have a mandate of not to go below a certain rating, and that explains why it's only AA plus and above that dominates the market. But if retail is able to stomach below AA, then perhaps that is the most encouraging sign of the growth of the market. Vijay, you form a very important piece over here because, and I want to ring this out if there are any equity guys also to listen. In the last 2 years, when we have seen this huge capital outflow by FPIs, the ones that have been sticky are actually the bond. You've hardly seen, a few $1 million of bond sales even in the worst of times during the tariff threats. But international bond investors have been sticky. So do you think the doors are sufficiently wide open as a person from the gift city who opens the doors a little wider to international investors? Is everything in place? And do you think that a gush of fresh wind and liquidity for the bond markets will come from international investors?
Thanks, Lata. The FPIs from a bond perspective have been net buyers and not net sellers as opposed to the equity. And if I was to look at some numbers that I briefly look now, the FPI limits on corporate bonds, if I'm not wrong, is only 20% utilized.
Yes.
Approximately, right? So still there is an 80% room for it to be utilized. That's number one. Number two being that now there is definitely an yield kicker for these guys to really come in. So there is, the spread is widening, right? Be it
are you referring to corporate bonds? Are you referring to even G-Secs? Even
Both.
G-Secs, it's only about 20% bond.
It's about 20, yeah. So even on the corporate bond side, there is this yield kicker which is there. So through the VRR route or whatever route, so there is a lot of people who are now eyeing the market to really come in. So there is a significant headroom for the FPIs to still flow in and really come in, right? And thirdly, with the inclusion of the Indian sovereign bonds in the international indices, that's actually been a significant step in the last year that has happened, which has actually slowly started getting the kind of proportion of the FPI investments back into the country. Having said that, is it going to fully open the doors, or there are still things? The taxation is a bigger issue, right? As you in your initial statement really pointed out, that debt is still at the mercy of policy rather than going hand in hand with the policy. So I think so, with all of these things, really, I would say the platform is well set. Some changes in the policy, some parity with the other asset classes, which is far more riskier than the bond market. If there's a parity, I think so that it will open the doors furthermore for all of these investments to come in. And if we need to realize the dream of a Viksit Bharat 2047, which is seen by a Honorable Prime Minister, I think so the inflow of foreign capital into the Indian bond markets for long-term infrastructure building is going to be very, very important. So yes, the door is slightly open. There is a lot more to do for it to be fully open. but yes, there's a lot of room for the FPI flows to really come in.
Okay. I will be asking all of you for one big idea to open the door wider. And I think I can outguess what you're going to say, but nevertheless, maybe you will have more ideas to give. I just want to tell you what I think, or the market worries as problems that show lack of development of the market. Both Chima and Deena have left, looks like, but I wanted them to hear. RFQ, did SEBI give up on persisting with quotes coming on the RFQ platform? It became a reporting platform. And for a while, SEBI persisted and then allowed it to be a reporting platform. You think insisting that the quotes come there would have been a good idea? Is that the next step that might perhaps widen and make the market transparent, liquid, etc.?
Yeah, I think if you look at some of the challenges which come in the way of growth for retail participation particularly is, you nailed it actually, it's liquidity. You know, what can be done to deepen liquidity? And in a way, I would say both the RFQ and the EBP platforms are very foundational for providing that kind of a momentum. Making it mandatory would certainly have ensured that there is more data flow which is taking place, more quotes which are coming, and therefore the opportunity. But I think that said, in the talk of Madam Chima, she clearly spelled out the budgetary-led reform agenda that is getting unleashed. I think that is sounding very exciting. I was hearing it with rapt attention, that frameworks are getting made for market makers and so on and so forth, distribution and so on. I think what is needed is that kind of an institutional framework which is taking care of the complexity of debt capital markets, and she explained it in the legalities of it and so on and so forth. So, simply making it mandatory, seemingly would give an impression that it's going to help, but I think the issues are far deeper. So, a more robust framework that SEBI is now talking about, I think could be a way forward to take, trust along, to take confidence along, to take sustainability along with
Fair point. Actually, Mr. Mittal was speaking to us before, along with Maninder Chima, before we entered, and he was saying how, the moment you have DSAs, the moment you have the last mile services, market makers, the markets usually develop for instrument after instrument. I guess when Manisha speaks to him, we will have a richer conversation with us. But Vikram, the extent to which corporate events get immediately reflected in the bond price is still not up to the level of equity. When I'm buying a share, I know if it is come bonus, come dividend, ex dividend, whatever. The corporate event is immediately reflected. That's not the case in bonds. A rating upgrade or a downgrade doesn't immediately get reflected. Or, if there is a restructuring, any kind of event. Is that one big leap that is still wanted?
Certainly, I think the level of disclosures that is there, the rapid speed at which the disclosures happen, and more about interpretation. So equity becomes an easy interpretation.
That's true.
The moment it is actually disclosed on the stock exchange's website, it's out there in minutes. But I think on a corporate bond, the impact is going to be a very different kind of an impact. So I think that knowledge and the last mile knowledge, when you're talking about retail, see, corporate institutional investors will always understand whatever disclosures are, because they understand the prices start reflecting events as well. And but for retail, it's a very different thing. I think it's not about the disclosure, but I think it's about how that knowledge gets interpreted in the investment decision is something that needs to be worked upon.
Okay,
I would just add, I think all that you said, we are very, very close to that, if not already there.
Yeah.
I mentioned the 40 odd OBPPs who are there. When we talk to them, they've solved the access problem.
Yes.
Systematically, as they get more sophisticated to attract more, all these ideas that you mentioned is on the anvil, if not already in the early days of launch. So it's going to get there.
If it is like next year when the second edition of this summit happens, if we are able to say that these have already achieved, then we are already on the way to. Yeah, Vijay, you wanted to add?
See, actually, what you posed to Vijay in the earlier part, and what was spoken earlier, this market is complicated. Right. So when we say that, is that going to be codes that's going to be matched? That we are sometime away for it. If I was to look from a very practical angle, and I have spent some time in this corporate bond market, 20 plus years in the Indian corporate bond market, right? and have a little bit of understanding of this market, if not really well. We have come a long way, where the markets were extremely opaque. There was absolutely no information available, to where each trade is getting disclosed, reported on the exchange, primary issuances, terms and conditions available. So everybody has an access on the public platform, on the websites of the depositories of the exchange. These are very easily available, right? Also, the regulator has played a significant role in some of these things, right? Today, we take a PFC as an issuer. We have maybe 50 odd ISINs outstanding. And if I was to take, say, maturing in 2030, we'll at least have 10 ISINs within the same month, right? So if there are no intermediaries here, right, and we say it's only going to be an order matching, that's going to be put up, it's not going to be possible. But another 3 years or 5 years down the line, this may slowly start happening. The reason being that the number of ISINs that can be issued by an entity is curbed. So that's come down to 9 or something by SEBI. So slowly and steadily, from about 13,000 outstanding bonds over the next 3 to 5 years, these number of outstanding bonds has drastically come down. And then we will then say that, okay, for every issuer, we'll have maybe 5 or 7 or 10 bonds outstanding. Then that makes it far more easier for somebody to do this, thing. So we are moving in the right direction, but it's not that we're going to really see that happen, in the very short term. So it's going to be a medium-term exercise, but we are in the right direction.
Okay. I really wanted to start off. Thank you very much for that, detail. We must know that we should not be comparing it with equities all the time. Globally also, it's in so many countries, debt is a hold-to-maturity market. So, let's not jump the gun. If you're making this progress like the two of you are saying, then we are, really getting there. Very quickly, since the clock is warning us, I'm going to forego some of the questions I had on IRFs. I feel very bad that, we have a fixed income market as far as, it's fixed as far as corporate bonds are concerned, and floating as far as banks are concerned. And it looks like never the twain shall meet, the way in which you're progressing. But that discussion for another day. Can I ask all of you to give me very quickly one suggestion, which we will present to SEBI or to the Ministry of Finance as an ask? Let me start with you, Sriram. Ask.
Yeah, I think we need to popularize the concept of bond index and derivatives based on bond index. That will help people understand the top issuers, and slowly people will start coming in. Derivatives can be a great leveler.
Yeah, derivatives perhaps at a certain level, but bond index definitely. Vikram.
I'll take the liberty of giving two. So
Please.
One, certainly what you mentioned, taxation and streamlining taxation around interest, etc., is important. But more importantly, not so much for regulator, but I think the focus on the way the regulators allow distribution to happen. Allow distribution to happen is going to be very important, because this market is going to be, it is going to require a lot of selling and a lot of explanations to get it into the hinterlands and increase the retail base.
Okay. As media, we accept the responsibility. We'll try and do our best. I thought when you said you have two suggestions, I was going to say I have three. Taxation, taxation, taxation. But Vijay.
Yeah, so you said two things. One is to the regulator, one is to the
ministry,
ministry.
Yeah.
Ministry ke liye to one single point agenda. I'll stick my neck out and say tax parity.
Yes.
If it is to the regulator, I would say, the reform around market making that they spoke about, I think accelerating that, more of that.
Yeah. So, okay, already on the agenda, one hopes we can put taxation.
So I don't want to repeat, what of these. Of course, taxation, tax parity is something that is a given. All right, but I think so. We are doing a phenomenal job along with the OBPPs. So I think so. What is very critical is going to be the creating and spreading the awareness of the availability of bonds in a very seamless manner. And also, since I'm here, I just wanted to make this point in the interest of time as well. SEBI very recently has come out with a consultation paper, right, wherein they are planning to give the OBPPs an extension of arm to allow them to offer the foreign currency bonds as well. So that is really going to be opening up the channels for the Indian retail investors to also look at bonds beyond the Indian shores. So right, people who are really interested and really looking to diversify their holdings, there is a very good opportunity with the SEBI consultation paper that has come out, to see how the OBPPs can really, lies in and tie up with exchanges like ours, which is there, and GIFT IFSC, to see how the, foreign currency bonds can be offered of multiple foreign issuers coming out there. So that's another, very, very interesting milestone by the regulator that's really come out. But yes, investor awareness and creating that kind of an seamless understanding of the bond, because bond is complicated, right? So that, because people still don't know what is an yield and what is a return, right? Or a coupon and an yield, still they don't understand the difference. So if, as long as this is really percolated well down, I think so, we've done a good job then.
Oh, absolutely. I mean, for every bond copy that I write or speak, I have to say that prices and yields go in the opposite direction. I mean, that is a necessity because it is a more sophisticated market. Our time is up, but I want to put one vote, one question to vote, since everybody wanted to make that as a suggestion. How many of you think that tax is the biggest obstacle, or tax parity is the biggest ask of the debt market? Hands up for those who agree. Okay, we rest our case. Thank you very much, ladies and gentlemen.
Thank you.
Thank you to our panelists. Thank you, Lata. May I request you to do the honors? This is our Grow Billion Tree initiative. And we are ensuring a tree is planted in the name of all our panelists today. Well, from bonds now, let's move to credit. As interest rates, liquidity, conditions, inflation trends, and economic momentum continue to shape market sentiment, one question remains central to investors and institutions alike. Where are we in the credit cycle, and what comes next? Understanding the evolving credit environment is critical in navigating risk, identifying opportunities, and assessing the outlook for fixed income markets in the months ahead. I see Prashant Nair already here. May I invite him to moderate the next session, please? Our next session is called Where Are We in the Credit Cycle? Joining him on the panel are Kruti Chetta, Fund Manager and Fixed Income Analyst, Mirae Asset Investment Managers India. Amit Tripathi, CIO, Fixed Income, Nippon India Mutual Fund. Suyash Chaudhary, CIO, Fixed Income Bandhan Mutual Fund. And Krishnan Sitharaman, Senior Director and CRO, CRISIL. Over to you.
Thanks very much for that. I must say that somebody outside said, well, we're all equity chaps moderating bond panels today, except, of course, our own very Lata. But the enthusiasm that I heard from, I think, Aditi earlier, Vishal, and, of course, our own Lata, is just infectious. I mean, you want to go out and buy a bond. But I think it's my honor to be here, and, of course, it's an esteemed panel. So let's kick this off. I think the question we are asking is where we are in the credit cycle. So let me just put that exact question to our panelists one by one. And why don't you kick this off, Krishnan? Where are we? Are we in the early stages? Are we in the mid-cycle? Are we in the late stage caution cycle? Where are we?
Yeah, thank you so much, Prashant. Very good evening, everyone. Pleasure to be here. When we talk of credit cycle, being from a credit rating agency, the way I look at credit cycle is what is the status of the credit quality landscape or credit conditions. So it could be benign, it could be risky, and so on and so forth. So today, the way I look at it is we are in a benign credit quality environment. And if I look at, say, corporates or even financial sector entities, balance sheets have improved over time. So if I look at CRISIL's rated universe, which we rate around 7,300 active companies, and if you look at, say, the leverage levels, the median gearing has halved over the last decade, come down from 1.1x to 0.5x. Interest cover ratios have more than around double, 2.7x to 5.2x. And if I look at financial sector entities, again, asset quality has improved, provisioning cover has improved, companies have a lot of cash on their balance sheet. So overall, we are in a I would say, benign credit quality environment, but we need to keep at the back of the mind that long-termism has to be key in our approach or assessment and analysis, because we need not be lulled by the fact that the last few years we've not seen too many defaults. But if I look at a 10-year horizon, we did see some defaults, large-scale, high-profile defaults actually, which actually paralyzed the market to some extent for some period. Today, we should not forget those. Credit cycles come up and down. Credit quality can deteriorate, and we need to keep that at the back of the mind. Robust credit assessment is the need of the hour. But today, as I said, I think we are in a benign credit environment.
Benign credit environment. Suyash, you want to sort of jump in there? Your assessment?
So Prashant, I would agree, and there are 3 or 4 highlights or aspects that I'd want to point out. First is, I think it's becoming very much more sector specific, because given the context of the war, and so there's multiple shocks that the system is facing over a period of time. The other thing is, over the last few years, we have had a very large retail leverage cycle, but the starting point was very large or healthy amounts of capitalization. So clearly, you're not seeing much there. And you also had, corporates starting with very benign balance sheets, and you haven't had much of a capex cycle, which would draw that, kind of resourcing out. But I would say, where we are now, and not really from a credit deterioration standpoint, but the right pricing of credit, we are in essence in the midst of a funding shock, which is coming from a sustained period of balance of payment deficit. And so the country level lack of dollar funding is percolating into liability side, funding, I would say, stresses in terms of availability and cost of capital across the board. And on the other side, you are seeing probably a once in a decadal, if not more, shock from the commodity cycle suddenly flaring up. The lack of the India-US deal probably pressuring the SME, MSME sector. So not so much of the credits that we as mutual funds get exposed to, because most of what we are talking about may not be issuers in the market. But I was just caution, that things are different for different people now, and there is a generalized, need to right price. Because if you're the holder of capital, you are, basically the setter of the narrative right now. Because in essence, what we are facing is a bit of a paucity of capital.
When you say a bit of a funding shock on the liabilities side, is the chase for liabilities was there even before, or this is something which has happened now because of what's going on?
So, used to be a...
because I thought liquidity was ample. Or that's not the case. Or you're saying it's ample for some, but not for many others.
So where we would distinguish is, the availability of what we called liquidity under the liquidity adjustment facility of the RBI, which you measure as net repo, reverse repo, and the actual presence of enough liability side on balance sheets. So basically, despite 4 lakh, 5 lakh crores of surplus liquidity in LAF levels, what we all understand is banks don't create or destroy liquidity, neither do corporates create or destroy liquidity. So what is lacking at this juncture is probably, and this is a 2-year-old problem now, that the BOP level stress is, giving rise to what is otherwise known as the impossible trilemma, which is that, if your external account is under pressure, that shows under rupee pressure, and that goes against the independence of monetary policy. So what you're seeing is the 5-quarter repo rate is basically irrelevant for the market. And therefore, that fundamental anchor of where rates should be versus the repo rate for the time being is lost. So I'm coming not so much from, that there is large-scale credit stress building, which clearly it doesn't seem to be. I'm just coming from standpoint of right pricing of all spread across the curve, because still, this BOP stress is with us. Probably the funding stress is also with us.
Fair enough. And we'll come back to some of the macro points in just a bit. But Kruti, you want to sort of address that? Just a quick assessment.
So, like rightly pointed out by both of them, but also I would like to go back to the few panel discussions that have been there before this, right? It's a matter of trust. And we've seen that come back in the bond market after a long time. Bond markets have gone through 2013. They've gone to the other NBFC crisis, but every time that we have come into the market, we've come back with stronger regulations, stronger systems. And not only in India, anywhere the function of a market liquidity or function of market building up is the function of regulations, which is why we see more active markets in some regions and we don't see active markets in some region. So we've seen worst of it in 2022, we've seen worst of it in 2013. We have certain things in place where regulations have also come in place, and at the same time the government support has also come at right time. We see that announcements happening. So yes, there is a stress, there is economic stress that we see because of balance of payments. Obviously, we see other credit to deposit ratio has also widened a lot. But given that the systems are in place and we are now, before we used to be more reactive, now we've become more proactive when it comes to regulations also or any measurement that has to be taken. Therefore, this feels that we will go through this cycle smoothly, rather than there obviously will be pockets of it, because ultimately credit cycle is a function of what derives from the economic measures, right? So how long this situation goes on, obviously it will be a derivation of it, but if it is something that we can contain it or it is short-lived, then we will see that we will flow through this cycle very smoothly.
Fair enough. I mean, I think for about 2 years, credit growth was a little lower, then it started picking up towards the end of last year. All the way into February, it was looking fantastic. And then, of course, late February, this entire thing started, and credit growth, etc., has taken a bit of a hit. I mean, your first thoughts on that exact question, which is, where are we in the cycle?
Yeah, I think the best of balance sheets improvements are behind us, which does not mean that balance sheets are looking bad right now, but incremental improvements are very difficult to come by from here on. The second is, if you just segregate corporate credit and retail credit, on the retail credit side, cash in the consumer hands is slightly better right now in the last 6-8 months. That's what you referred to when you talked about the consumption cycle. But there is a K-shaped element to that, so we have to be careful on that side. There are parts which are doing very well, there are parts which are not. The last point, I think Suyash and everyone has already spoken. I think I would agree with Suyash's point. While the balance sheets are good, we are today as an economy struggling to fund 13% credit growth, which means that somewhere the market infrastructure is becoming an issue. This is a macro structure issue. And the second macro structure issue which we need to address is this complete breakdown in terms of transmission, at least as far as debt capital markets are concerned, vis-a-vis the policy rates. I can amplify Suyash's point by telling you that today banks are borrowing 3-month money at 225 basis points over repo. The last time that happened was in a crisis period. So somewhere I think we need to manage the macro level issues properly at this point in time, so as to ensure that the liquidity issue does not convert into a credit issue in the near term.
When you said that we are struggling to fund a 13% credit growth overall, I mean, just is it because of some of these rate distortions across the curve? Is that the issue here?
No, so very frankly, I think banks are possibly the only large providers of credit in this at this point in time, because of various structural issues. Debt capital markets have still not reached a point where you can use them as a fallback mechanism for availing credit at all points in time. We are at best seasonal fair weather friends in most of the times. In any kind of a macro stress which we are going through right now, The moment you see liquidity getting uneven across the ecosystem, wherever you see some amount of friction in terms of liquidity, which is essentially the friction flowing out of the BOP issue, you are suddenly seeing banks struggling to fund a credit growth which is actually much lower than what we were used to funding in the last 10 to 12 years. So it is essentially a market, I don't know how to put it, a market infrastructure or macro market level issue that we are facing right now.
Okay, so I thought I'll start with corporate bond infrastructure, spreads and all of that question, but I think Suyash and Amit both have raised the question of the macro level stress, if I can put it like that, which needs to be solved. So let's jump straight to that. I mean, it's a I don't want to use the word crisis type situation, but it's been a stressful situation. Maybe things are, things have come up a little bit from extremely stressed levels over the last maybe 76 hours, maybe a little more. Suyash, but what needs to be done, in your opinion? I mean, what's the repo is at whatever, 5 or the 10-year is at 7. As Amit said, you're borrowing 3-month money at 200 plus basis points over the repo rate. Are we looking at what are we looking at? I mean, 5th of June is the policy from the Reserve Bank. What should we expect?
So Prashant, used to be a time not so long back, in fact most of our careers, what we used to track as the fundamental point to be bullish or bearish fixed income was the status of country's current account deficit, right? And actually somewhere in 23-24 we became extremely bullish on interest rates because we saw what we thought was almost a structural compression of a current account deficit, courtesy the services trade balance moving from a 5 billion surplus per month to 15 billion surplus per month, largely owing to the GCC phenomenon. And that looked sustainable to us. However, the last 1.5-2 years is not about current account, but the funding of what is even a modest current account. And to us, the starkest measure there is what is known as basic balance, which is net FDI plus current account deficit. So that tells you the sustainable level of current account that the country can run. And the basic balance has actually been negative for almost 2 years. So then we started to hunt for reasons as to what could be changing, because certainly nothing much was changing for us. Our inflation credibility is fine, fiscal credibility is fine, growth matrices have been okay. So something has changed for the world. And there are 3 things that we can distinctly figure out that has changed in the world. The first, and I think it's very, very underappreciated, although we talk about it, is that the average level of global rates has set up. So, in the post-COVID, post-Russia-Ukraine inflation shock, we used to say that, Fed has hiked, US rates have gone to 4 to 5%, but they won't sustain there because those economies are not built to handle these rates. But guess what? They are thriving in those rates, right? So, if you're any sort of a global asset allocator, the risk-free rate that you now have to beat is higher. And that may not be showing as, debt flows, but certainly banking flows, challenge in ECB raising, etc. So, the capital account is reasonably fungible. The second thing that has turned is now you have competing themes for capital allocation around the world that are very powerful. So look at the AI theme. You're talking about $1 to $5 trillion companies, right? So it's no longer, emerging markets growing at 10%, attracting capital from the rest of the world. It is, these large balance sheets that are, posting 15, 20, 25% growth rate, not to mention the AI capex cycle that has started in the US. So if you're a global portfolio manager, you have high global rates and competing themes around the world. So probably 10, 12% nominal growth rate is not good enough. And the third point, which, also needs to be thought about, is that the second largest economy in the world is sitting on this massive excess capacity. So how can you really have a broad-based manufacturing capex cycle anywhere else in the world, but for the themes that are topical today, right? So if you have to lift 200, 300 basis point investment to GDP, I'm not talking about specific sector, capex, but aggregate 200, 300 basis point, you could potentially argue that if not for the capex associated with AI, the narrative is just not there. So it's basically this combination of 3 things, and that has now been in play for last 1.5-2 years, that is essentially leading to cheapening of your asset base. Now the problem is cheapening itself is not good enough. You need a narrative alongside the cheapening. And a sustainable turn to this can really happen only with two things. Either global rates for whatever reason start to come off, or the AI theme starts to fatigue itself. You may get a temporary reprieve with the war cessation, because that is, to us, the fundamental issue with the war from just the market standpoint is not the inflation impact, not the growth impact, but the BOP impact, the balance of payment impact. See, at this juncture, I would probably, most of this panel would agree with me, nobody even cares if RBI repo rate was at 6%, right? Provided in the journey to 6%, they did not destabilize our rate hike expectation. So it should not be an intermeeting hike like what happened in the last cycle, but nothing is being priced of 5 quarters. So look at term spreads, your back end of the government bond curve is sitting at 770. The post-COVID high, when fiscal for India peaked at 9.2 and Fed funds rate peaked at 5 quarter to 5.5, the long end of the government bond curve peaked at 795. We are at 770 now. Right? So nothing is being priced off it. And to my earlier point, the term spread market is showing stress. To Amit's point, the AAA blue chip funding market is showing stress. And therefore, any sort of capital allocator has to do right pricing today.
So just to finish that loop, there is of course waiting for the AI trade to fade off and oil prices to fall and the war to settle down or excess capacity to be used up. Those are external, not some, right now, say for example, out of Mumbai, the RBI, what should we expect? Just to close that loop off. Because do you have to react in some way to what's happening right now or wait it out?
No, I would say, given that average inflation forecasts have to invariably move up, and RBI is first and foremost an inflation targeter, they should start the rate hike cycle going. But at the same time, ensure that they don't unanchor markets' rate expectations. So you don't need a fresh pressure point coming from mixed commentary from the RBI. So you start the rate hike cycle going just to, continue to be credible as a conventional inflation targeter. But it won't solve much for the time being. What you could potentially hope for is a benign confluence of events. And I am not operating via perfect wisdom. I'm sure there's a big piece I'm missing here. But what we can think as a benign confluence of events is some sort of a dollar bond strategy to whatever extent jumpstart it with a $30-40 billion flow. The cessation of war that takes commodities, so let's say oil back to 85-90. And then at some juncture, if the shock to the US economy, because that's also a K-shaped economy, starts to show in their labor market and Fed rate expectations were to turn again, then you could potentially get a window where dollar depreciates. In 2025, dollar depreciated, we didn't benefit. A lot of other EMs did. But hopefully this time around, because we are cheap enough, that could potentially show with us. And so you need that jump start to happen, and from there you can build that narrative.
So start the rate hike cycle and probably a dollar debt issuance, which brings in a chunky amount of money, and then wait for some of these other things to fall in place, hopefully. Fingers crossed.
Yeah.
Just to sort of, you addressed that same point, so I just want to come back to you. If you want to add something to what Suyash said, and we'll move on to the next topic.
No, I think we can move on because it's about regaining the status as the inflation fighting central bank. I think they need to speak that language. They don't need to spook the markets. They need to start early so that they don't overreact at some point in time. But just to add one point, I think, yes, there is a larger macro issue around BOP and liquidity impact, etc., etc. There is also internal micro issue in terms of money flowing within capital markets to various segments. I don't want to repeat what Lata has already said. You need to address that sooner or later. Believe me, there is money flowing into such segments where you get taxation benefits vis-a-vis debt markets. That is not funny any longer. You are actually curtailing flow of credit to where it is required.
Which means, just to illustrate that point.
Just to illustrate that point, everything in India other than debt.
I see. The tax issue, which is
everything under the sun is taxed differently, and not all of it is productive.
Okay, yeah, no, 100%. I think, and that's a jab at equities, maybe.
No, it is not. When I said everything, it includes everything that is non-debt.
Yeah.
And nothing against any other asset class. Everything needs to grow, but debt also needs to grow. I think we have created a market architecture issue now in terms of the simplest solutions also not being solved through debt. Everyone is going to everything other than debt, even to park 1 month money today. So that's the situation.
Krishnan, just to sort of come back to the where money is going, who's being able to access money. Are investors sort of, concentrated in what is perceived as safety in that sense? I mean, in the AAA, and are other segments kind of below that found wanting for money, or you think it's kind of evenly distributed? While from the top it looks like, well, as you said, it's pretty benign, but what's happening under the surface?
I think that's a very good question. From my perspective, I see a paradox. When I talked about benign, I was talking about from a credit quality landscape, situation is benign. But at the same time, if I look at the bond markets, they are very muted. Last 6 to 9 months in terms of issuances, it's actually negative vis-a-vis similar period of the previous year. But just from a background, a more long-term picture, if we have to kind of have a very strong broad-based economic growth and a resilient financial system which supports our move towards Viksit Bharat, what we need to have is the banking system and the bond markets both complementing and competing with one another and ensuring that there is a steady stream of low-cost funding to India Inc. Now, today, if I look at, while banks are reasonably doing well on major parameters, deposit growth is an area where they are still struggling with. Today, the gap between deposit growth and credit growth is around 300 plus basis points, which is not sustainable for a longer period of time. So they are, as Amit pointed out, looking at short-term CD raising. Some of the private banks are looking at securitization. They can issue bonds and so on. But unless deposit grows in a sustainable manner, credit may not grow to a large extent. Now, coming to the bond markets in India, historically, it has been narrow. Access to bond markets have been to AAA and AA credits only. 90% of the issuances are in these segments. And we need to take a series of steps in both the supply side and the demand side to ensure that we have a more vibrant, deeper bond markets. Today, if you look at the US, the corporate bond market as a percentage of GDP is 45%. India, it's 16%. Securitization market in the US is 53% of GDP. India, it is 2% or less than 2%. So unless we grow these, for instance, securitization and covered bond from a supply side perspectives, if it has a proper policy support, it can help lower rated credits, the mid-rated credits, access the bond markets. Today, an interesting study that we did was for A-rated corporates. The risk-adjusted return for investors is actually higher than in AA and AAA rated credits. And if I look at today the balance sheet, the debt protection metrics, gearing, interest cover, etc., for A-rated credits, it is actually has improved substantially the last 10 years. Today, an A-rated company is looking more like a AA-rated company of 10 years back. So that's how it is. And in terms of universe, if I look at our universe, we have 1350 A-rated credits. AA and AAA put together is 950. So that way diversity is also there. So unless we start moving down the credit spectrum, more from a patient capital perspective, also insurance companies, pension funds, it will become difficult to broad base the bond market. Other thing, of course, tax-related disparity is there. Other thing is the retail investor base in bond markets, while marginally growing, but still it's well below what it should be. And today, some option can be a tax benefit to them in, say, infra bonds. For instance, in Brazil, last decade, there was an incentive on infra bonds, and we saw a large proportion of retail investors investing there, and that segment itself picked up. We need to figure out some way of getting retail investors into the market, have a broader bond market, and the bank loan also needs to grow. So all that needs to happen for a smooth flow of credit into the economy.
Do you think on the retail point, I mean, taxation, you'd also agree? I mean, the panel agrees taxation is the number one issue across the board. When we're talking about, I mean, interest in, I think Amit said that, Suyash, you also agree with taxes?
So, absolutely yes, but I would put a slightly different point as well. We would be quite happy if the taxation benefit for the time being extends to the super good quality of the bond market. See, look, first and foremost, mutual funds are a very efficient way to intermediate savings, right? So the problem now is that even the best quality part of the bond market has very little retail participation, right? So you have, through RBI bond platform, etc., you have some. And you could argue that, through your PF, etc., you're getting indirect participation. But there are fairly lucrative rates sitting, relatively speaking, from an access standpoint, in just the AAA and sovereign market. So, a first step could even be that that part of the market, and I'm not so, it's just one starting point. I'm not saying that's the end point. Just that part of the market has some kind of a tax incentive if something else is coming in the way. So let's say, a mutual fund or any kind of a savings product, which only has, let's say, sovereign or public sector AAA exposure, and even, let's say, caps the total, manufacturing charges that they're going to put, even put those parameters in place and, give the taxation benefit, so that just, the depth of retail savings. So when we talk about development of the bond market, it's always the lower rated issuers. But frankly, today, can I liquidate 1,000 crores of a PSU AAA in the secondary market? The answer is no. Right? I cannot. So none of the large institutional investors like your, large insurance and provident funds are in the secondary market. And all of us mutual funds may be institutional investors, but our funds flow all happen in the same direction. So we are all selling or we are all buying. So how do you create, first and foremost, depth in the sovereign and AAA? So look at the sovereign market. There are 2 or 3 benchmark securities that garner all the volume, right? If you want to, let's say, create a 7-year sovereign portfolio, you can create it, but can you trade it on a day-to-day basis? No. So I think, I would actually encourage a shift in conversation a bit to first, provide diversification and liquidity to the best part of the market and then move down from there. And, that is how tranching will happen more efficiently without force fitting. So as an example, for a mutual fund, liquidity is paramount. So we may arrive at a situation where open-ended mutual funds have strict limits on how much of lower rated credit you could buy, but at the same time you could create structures, with liquidity gating that does that. Or you may find that banks are best, poised to service the AA minus and below part of the market and keep AA and AAA, more to the institutional market-facing players. So I think it's time that, we have some of those conversations with respect to the quality part of the market as well.
I don't know if the SEBI representative is here, but some excellent suggestions. But so you put it, the clock is up, but just a quick 10-second responses. Say this entire Iran issue and oil settles and it cools off a little bit. What are the 1 or 2 things you'd watch as you look ahead in the next 12 to 18 months with regards to the credit cycle? What are going to be the sort of markers? How would you assess how strong or how weak this cycle is going to be from here, Suyash?
So first and foremost, the re-anchoring of market rates to RBI policy rate. From there, reasonable volatility to credit spread pricing. So today, you are in an environment where the non-SLR curve moves by 50-60 basis points over 3 or 4 weeks. And then, take it from there. Like I said, and I think like Krishnan and Amit also said, it's a very disparate credit market right now. So there are parts of it where you have had 20% CAGR growth rate for 5 years. There are parts of it where there is excess capital, etc. So that part you can basically figure out bottoms up.
Krishnan?
I think 2 things. I would say interest rates and interest spreads stabilizing or coming down, and investors starting to move down the credit spectrum. These 2 are important for stability to come. Because the other thing why I'm saying that is because today, AAA corporate is also going to the banks to borrow rather than from the capital markets, because he's getting finer rates there. So there needs to have some semblance of stability.
Kruti?
Credit to deposit ratio, as we are already watching, and how the NBFC spreads are moving, because NBFC is the key pillar where your small industries get financed, and if there the stress is coming, then probably it's a wake-up call. So credit to deposit ratio.
Amit? Sorry, I'm coming to you last. So others have spoken.
That's okay. It's a slightly different take on this. I think we should just work on allowing the markets absorb this risk. So let's just work on the infrastructure part. I would think that we should make sure, Maninder madam also mentioned about it, we should make sure 18 months down the line, if any investor has the risk appetite, he should not be unable to buy a bond just because of lack of capital. So just make the repo markets work. Believe me,
Which is you should be able to repo corporate bonds, basically.
You have to allow people to borrow against in a repo market, which should be liquid, available to everyone. Risk appetite is very different from balance sheets. Just to extend Suyesh's point for 1 second, it does not matter if the EPFO does not buy AA bonds or single A rated bonds. If I have the risk appetite, unfortunately, I don't have the capital and he has the capital, right? So you only need to move capital from people who have money to people who have risk appetite. Repo is the only way to do it. Just do it properly and the markets will become much more liquid. We'll be able to handle some of these stresses much more easily.
I mean, I think excellent suggestions, excellent conversation. Amit, Shruti, Krishnan and Suresh, thank you very much, all of you, for being here. Thanks very much for being a wonderful audience. Thank you.
Prashant, may I request you to do the honors? The Grow a Billion Trees certificate that promises to plant a tree in the name of all the panelists and speakers here today. Thank you to all of you. And Prashant, may I request you to stay back, please. All right, now we are moving on and talking about why fixed income matters at all. So as markets evolve and investor priorities shift, fixed income is increasingly becoming a key part of building a balanced and a resilient portfolio. And at a time when volatility, global uncertainty, and changing market cycles are reshaping investment strategies, investors are now beginning to look beyond short-term excitement and focus more on stability, diversification, and long-term wealth creation. So how should investors be thinking about investing, whether on autopilot or actually reviewing? And where does fixed income fit into this narrative and a modern portfolio story? May I invite on stage Basant Bafna, Head Fixed Income, Mirae Asset Investment Managers, India, to come on stage, and Prashant to take over for the fireside.
Thanks again. Thank you, Basant, for being here. So, you know, the case for equities is often made at conferences like this. The case for bonds is not made often enough, and I think that's what we're doing here. So it's great to be doing this. But is that sort of, you know, in your assessment, how people view bonds? I mean, you know, either the long-held view always has been that, well, either chase growth, buy equities, or go absolutely safe, and then you sort of start thinking about fixed income. So has that balance started to come through, in your opinion, with how people think about, how investors think about fixed income, about bonds?
If you look at the overall asset allocation of investors, and especially when you look at through the mutual fund route, I mean, you distinguish between retail investors and institutional investors. And when you look at how asset allocation has happened over a period of time, retail investors are increasingly tilted, and they've continued to do so by way of either equities or hybrid funds. But if you look at, say for instance, ETFs also have increased over a period of time. But if you look at fixed income, I mean, as an asset allocation, it's been significantly minuscule. And if you look at the money that's lying in traditional bank deposits, it's significantly higher. But when you look at overall asset allocations for investors, and when you put money in a bank, I mean, of course, banks also look at their asset liabilities, right? And when they look at their overall assets and liabilities, typically you have, and Lata alluded to that earlier in the conversation, that, you know, you have floating rate linked assets, which is significant in your balance sheet. And to fund that, you know, your overall requirement of funds is broadly concentrated in the shorter end. So that's why when you look at your bank FD rates, your bank FD rates are primarily the best in the 1 year part of the curve. But that is something that suits the asset ALM of the bank, right? But when you look at an individual, when I look at my asset allocation as an individual, Of course, we've seen the euphoria of equity markets post-COVID, and we've seen a significant amount of returns, significant amount of leverage. But when I look at an overall asset allocation, and if I have an asset liability requirement, then you sort of try to blend your asset liability requirement based on the underlying balance sheet of the bank. But if you have a specific requirement, say for example, if I want to buy a car 6 months down the line, if I want to buy a house and I want to accumulate funds, say over a 5-year period because I have a plan in the future, the rates that markets offer, and Suyesh, Amit, they've referred to dislocations in the bond market right now, is significantly higher, and at the same time, you don't get exposed to the kind of refinancing risk that's there when you are sort of looking at investments. And when you look at the rate disparity between what the traditional bank deposit offers and what markets are currently offering, there is a huge disparity, because when you look at the underlying markets, when you look at, say, for example, OIS, and which is again seeping through into the overall credit markets, the disparity between rates is quite significant. You have overnight rates which are ranging within the lower end of the LAF corridor between 5 to 5.25, and at the same time you have CD spreads, AAA PSU, which are ranging, at least for 3 months also, you are having spreads at close to 225 basis points, which is quite significant, as close as a crisis period. So when I look at myself as a retail investor, if I have, for example, a short-term requirement, why don't I try to maximize that and try and at least get that benefit into my own balance sheet, and at the same time get my liquidity at a time when I really need it? So if I have a requirement, say 3 months down the line, but what if there is a requirement to take money, say 5 days before, the liquidity availability which is there for mutual funds and the kind of products that are available across the suite, that's sort of something that investors can always harp on and try and maximize their overall gains.
So the products are there, right? I mean, across the mutual fund ecosystem. That is absolutely correct.
Yeah. So if you look at how SEBI has categorized and rationalized overall mutual fund schemes on the fixed income side, so there are two parts to it. One is where specific schemes are linked to duration. Right? So, say for example, a liquid fund can invest in securities which are up to 91 days. You have 3 to 6 month buckets, 6 months to 1 year bucket, and up to 1 year like a money market. And then you have on the duration side, so right up to a overnight requirement of money, wherein you get a direct pass through of TREPs, to a long duration product wherein you have, say for example, and it's really dependent on how you look at it, right? So if a senior citizen, say for example, I'm closer to retirement and I want a fixed income corpus, but at the same time I just want to lock in yields for a longer period of time, I can have a systematic withdrawal plan, invest in longer duration bonds, and rely on the income that I received out of that. And yields are extremely attractive at this point of time. If you look at 30-40 year GSEC, you are at closer to 770 levels on a semi-annual basis, annualized basis, yields are higher. So when I look at the spectrum of themes, one is on the duration side and the other is on asset allocation. So you have money market funds which are meant to look at products, underlying products or securities which are only up to 1 year. You have banking PSU which looks at only high quality banking and PSU stocks, securities. Then you have corporate bond funds and so on and so forth. You have another category which is a dynamic bond fund wherein you rely on the asset manager to take duration calls or credit calls on your behalf. So spectrum of products are there. It's already available. The only need of the hour, and through you maybe I can make this request, is that more and more investors should be able to make use of that, take benefit of it, and try and ensure that their overall requirements of liquidity over a period of time is aligned perhaps to the underlying duration of the fund either, or if you are an aggressive investor, you can try and maximize your overall gains also, because when you look at the underlying sort of schemes, it's a direct pass through of underlying valuations that are there. So when you have interest rates which are extremely elevated, not reflective of the current market conditions, and at that point of time when you start seeing, say for example, resolution of the conflict or yields start cooling off because of, say for instance, dividend pass through to the economy, broader economy, and with that yields start cooling off, you get a pass through of that also, and at the same time you can use that to sort of look at asset allocation on other asset classes, or at least meet your overall requirements?
So it's an awareness issue, basically, Basant. That's what, it's an awareness, the messaging,
Yeah, so if you,
it's not been sold well enough.
If you look at, say, tier 1 cities to tier 2 cities, the asset allocation is quite different. You look at top 30 cities versus cities below. The asset allocation is significantly higher for top 30 cities as compared to the bottom cities. Similarly, when you look at retail investors versus institutional investors, the asset allocation of retail investors are primarily concentrated towards, say, equity hybrids and so on and so forth. But if you look at institutional investors, they are the overall asset allocation is quite balanced between debt, between equity, between.
My
ETFs,
question
so
though was more retail. I mean that category. Institutions, yes. I mean they're well balanced. But my question was largely focused on what.
Yeah, so I mean at a time when as.
And yes, there is a taxation issue, and perhaps that gets sorted out, etc. But we're saying, well, at some point that will get corrected. It won't stay like that forever. But what needs to be done in your opinion?
So fixed income markets, of course, are complicated. So Suyesh alluded to this as well during his remarks that, how do you sort of explain, I think it was Datta who alluded to the fact that, you talk about yields and prices and you put disclosures around it, right?
That we do, as she said, with every piece. But yeah, go on.
Yeah, but if you look at the underlying theme, now SEBI has made it so simple. And it's a matter of, time wherein you have the underlying youth coming into the economy, understanding more complicated products. But at the same time, when you look at the underlying classification, what SEBI has done, you look at classification by way of duration, while you look at mod and macular duration, all of that. But if you just simplify it and you talk about, if I have an investment horizon of 6 months, if the fund is operating at a 6-month duration, just try and simplify it and talk about yields which are prevailing at, say, for example, today, close to 770 to 780. And you look at traditional fixed deposits, which are at, and it's very simple message to take, right? So you have fixed deposit, 6-month FDs are at closer to 6% or perhaps below that, right? And the underlying instruments in which you are investing is actually the same as the bank that you are placing your FDs with, right? So as and when you start having that understanding that, once you get liquidity, second you get better yields, at least 175 to 180 basis points, or if not higher as compared to a traditional FD, and you get the taxation sort of incentive also, in the sense that, in FDs, if you are placing FDs for a longer period of time, your taxation is, of course, quarterly, and then, your compounding does not happen on the overall amount, whereas in mutual funds, you get compounding continuously till the time you don't actually take the money out, right? So from that perspective, there are multiple benefits to it. It's perhaps an awareness issue. And by way of I mean, that's something that all of us need to work upon. And we've seen success stories, right? We've seen SIP Sahi Hai working out, and you've seen retail participation growing immensely on that front. Of course, taxation goes a long mile in increasing, the appeal of these products. But at the same time, traditionally also, if you look at the core of the product, it still is very attractive.
It has product innovation sort of, leaped ahead, far ahead of adoption itself? I mean, is just innovation in the space, product manufacturing, I mean, the kind of stuff which is happening. The variety of products available in the fixed income space, as you said, alluded to, I mean, is vast, right? Are we seeing a fair bit of innovation here as well within these products?
So, the categorization itself is, quite diversified in that sense. But we do have, some mix of equity and debt products. You have, of course, hybrid funds that are there. But along with that, you've now had the SIF category wherein you are looking at generating additional alpha by way of use of derivatives on the equity side as well as on the debt side. So innovative products are coming in. And now, you have that benefit of not just relying on derivatives for hedging, but be able to generate additional alpha by way of derivatives as well under portfolio. So you have innovative products that are coming in, but the key message is that, you need to first increase the overall participation in the traditional products itself, right? And the underlying products which get more and more complicated, you first need to build those bases for the first line and then move towards introducing complicated products. So broadly what is happening right now is that these sort of products are meant mainly for institutional investors because they understand the risk, and that's why there is a threshold also to the amount that these investors can invest. There is a minimum threshold because you expect that these investors understand the underlying products and the risks that are involved in those products.
What is the one sort of mistake that you see? I mean, throughout your, what is the most common mistake people make when building long-term portfolios, trying to achieve this balance between growth and stability in their portfolios? Basan.
If I want to keep it short, don't look back and make investment decisions. There is a lot of opportunities that lie, but you don't need to be clouded by what's happened in the past. So if you've seen a lot of volatility in the recent past, you look at the fundamentals and you see that there is still a lot of value. Let me just give you an example. Now, over the last 3 decades, on a decade-on-decade basis, you've seen inflation become significantly lower over a period of time, right? And when you look at the next decade, and you look at a product which sort of beats inflation, you look at long durations, for example, 30-year, 40-year papers at closer to 770, and if you consider the next decade as a 3%, 4% sort of inflation, what is a risk-free product that beats inflation by closer to 370 basis points? Right? So fundamentally, if it makes sense for you, it makes sense for you. But if you look at the past and you say that yields are going up, markets are uncertain, but over the next decade, your economy is still very strong, right? So you look at an underlying asset allocation and you invest. That sort of perhaps is of more value rather than timing the market.
I think that advice holds true for equity as well. Don't look back, look ahead when you invest. And as you said, perhaps a nice slogan for bond markets, right? Like as you said, SIP sahi hai, mutual fund sahi hai. We need equivalent of that for bond markets as well. So maybe we'll come up with something. Thanks very much, Basant, for a great chat. Appreciate you joining us here on stage. Thank you very much.
Thanks, Prashant.
Thank you.
Thank you, gentlemen. All right, so far we have explored the evolving role of bonds, the credit cycle, and why fixed income is becoming increasingly important in today's investment landscape. But now it's time to take both a step back and a look forward. Our next fireside chat will reflect on the journey of India's bond markets. How far have they come? And what lies ahead as the ecosystem continues to evolve. And to decode the history of the Indian bond market and the way forward, please welcome CNBC TV18's Manisha Gupta, who will be in conversation with A.K. Mittal, MD and CEO, A.K. Capital Services.
Well, the tea break's done, and we are here for a masterclass now as Mr. Mittal joins us. Mr. Mittal, thank you so much for taking time. और हम यहाँ पर full masterclass करेंगे, जानेंगे कि bond की history क्या है, and यहाँ से way forward क्या है आगे. Mr. Mittal, 90s में ये बहुत controlled market हुआ करती थी, और फिर हमने देखा market-driven auctions यहाँ पर होते थे, institutional overhaul था, corporate bond markets में एक rise आता हुआ देखा. प्राइवेट प्लेसमेंट बूम्स आए, उसके बाद हमने रिटेल एक्सेसिबिलिटी यहाँ पर आते हुए देखी, और अब तो हम यहाँ पर डेरिवेटिव्स की बात कर रहे हैं, टोकनाइजेशन की बात कर रहे हैं. कैसे देखा है आपने ये पूरा चेंज, और आप क्या कहेंगे, व्हाट इज द मेजर फंडामेंटल गेन दैट वी हैव सीन अक्रॉस द मार्केट इन ऑल दीज इयर्स?
राइट. तो आई एम द ओनली स्पीकर जो हिंदी में बात करेंगे. आई होप यू विल एग्री विद दैट. आई विल स्पीक इन हिंदी. 1984 में टाटा स्टील सबसे पहले एनसीडी लेके आया था. वो एनसीडी अनलिस्टेड था और उसने अपने इक्विटी शेयर होल्डर्स को ही वो एनसीडी दे दिया. इसके बाद इशू.
Aditi, would you want to join us? Mr. Mittal, 1 second. Aditi, please. Yeah, I was looking at that chair and wondering.
Yeah, for you. 94 में IDBI, IFCI, ICIC 16 करीब 25 साल के लिए पेपर लेके आए और उसका नाम दिया उन्होंने फैमिली बॉन्ड। उसका ब्याज था 16%। 25 साल के से लेके 29 साल के पेपर थे वो। ICICI बैंक ने अच्छा किया, उसमें पुट रखा। IFCI ने बाद में उसको फोर्सली मैच्योर कराया, कोई क्लॉज थी उसके अंदर, वो 7, 8, 9 साल में बॉन्ड मैच्योर करने पड़े। चूंकि 16% का ब्याज पॉसिबल नहीं था। वो बात अलग है कि उस समय इन्फ्लेशन भी 8-10% था, जो ग्रॉस इन्फ्लेशन था। उस बॉन्ड को बेचने के लिए हम बाजार में गए। उस बॉन्ड को बेचने में क्या बात थी कि हमने कहा सीधा ये आपका पैसा 4 गुना हो जाएगा, तो आप इस बॉन्ड को ले लीजिए। हमारे को बहुत अच्छी फीस मिलती थी, मतलब ब्रोकरेज करना चाहिए, 1.5% की फीस हमको ICICI बैंक, IDBI बैंक ने दिया। तो वी वर सो हैप्पी। बट उसमें क्या था? कुछ भी नहीं था। उन्होंने उस बॉन्ड से पैसा लिया और बाजार में क्रेडिट के लिए उतारा। तो आप देखिए कि जो 16-18% पे पैसा गया, तो IFCI उस बॉन्ड के चक्कर में साफ हो गई बाजार में से, क्योंकि 96 में हमने बॉन्ड उतारा और 2001 में IFCI के साथ प्रॉब्लम आ गई। ICICI बैंक ने खैर उस बॉन्ड को रिडीम कर दिया एंड से। तो वो जो टाइम था वो बॉन्ड मार्केट नहीं, बल्कि कोई भी इंस्टीट्यूशन अपनी रेपुटेशन, अपनी स्ट्रेंथ के बेस पे अनलिस्टेड पेपर बेचा करते थे। कोई IM नहीं होता था, किसी तरह का कोई कॉवेनेंट नहीं होते थे। इन्वेस्टर सिर्फ ये देखता था ये बॉन्ड किसका है। टाटा ने बॉन्ड निकाला, उस समय कुछ ग्रासिम के बॉन्ड आए। रियल बॉन्ड जिनकी हम आप बात कर रहे हैं, वो बॉन्ड बहुत बाद में आए अपने, जिनकी मैं भी एक के बाद एक डिस्कशन करूंगा। मैं बीच में जैसे मैंने कुछ पॉइंट लिख के लाया हूं, तो माफ करना, मैं इसमें से देख के कुछ बोलता रहूंगा, आप लोग मुझे परमिशन देंगे। 2000 में इंश्योरेंस और 2008 में PF पेंशन ग्रेचुटी इस बाजार में आए एज ए सब्सक्राइबर। इस तरह से बॉन्ड मार्केट का इवोल्यूशन हुआ। पहले बहुत कुछ ही गिने चुने इन्वेस्टर्स होते थे, बैंक की इन्वेस्टमेंट डिपार्टमेंट होती थी, और कहीं ना कहीं इंश्योरेंस कंपनियां तो जैसे मैंने बताया बाद में आई। HNIs वगैरह कुछ होते थे बड़े सेलेक्टिवली।
मिस्टर मित्तल, आपका माइक बहुत दूर है।
अच्छा, यस,
पास रखिए ताकि हम सब सुन पाए।
I would like to tell the audience, it's the first time my father has ever come on a stage.
But he's very, very prepared.
And I would like to say, 30 years, this man has worshipped bond market.
थैंक यू बॉस। जैसे मैंने बताया कि वो फैमिली बॉन्ड्स में पुट करके आ गए थे। बीच में कोई बाजार नहीं था, किसी तरह की कोई लिक्विडिटी नहीं थी, तो इट वाज हेल्ड टू मैच्योरिटी। तो उसमें आमतौर पे जो लोग इंडिविजुअल थे वो आते नहीं थे, क्योंकि उनको लिक्विडिटी की जरूरत थी। तो यहाँ से हमारा ये बाजार मनीषा शुरू हुआ। अब ये जो बाजार पहुंचा है, हमसे पहले सभी लोग बता चुके हैं कि आज बाजार में लिक्विडिटी है, उसके लिए सबसे बड़ा काम OPPP कर रही है। और अभी मैं उस फिगर बोलूँगा कि उन्होंने 26 लाख ट्रांजेक्शन्स करे हैं। पहले साल में वो 19 लाख ट्रांजेक्शन्स थे, एक साल में ही 26 लाख ट्रांजेक्शन OPP पे हुए हैं। दैट्स ए रिकॉर्ड। आज कोवेनेंट में हम लोग उसमें पूरी सारे कोवेनेंट डालते हैं। जो पहले कोवेनेंट्स होते थे, जो शुरुआत में वो कहीं ना कहीं इशूअर के फेवर में होते थे, आज जो कोवेनेंट हैं वो हम लोग इन्वेस्टर के फेवर में बनाते हैं। क्योंकि हमारा कहना है कि जो इशूअर के पास पैसा आ गया, वो पैसा अब वापस विद ब्याज इन्वेस्टर को मिलना चाहिए। तो मार्केट इज टिल्टिंग।
सो मिस्टर मित्तल, आप कहेंगे इतने सालों में इतने सारे चेंजेस यहाँ पर हुए हैं, गवर्नमेंट बोरोइंग्स बहुत बड़ी है, ग्लोबल अनसर्टनिटी इतनी ज़्यादा है, आपको लगता है इंडियन बॉन्ड मार्केट अब मैच्योरिटी की तरफ जा रही है?
देखिए, इंडियन बॉन्ड मार्केट अभी शुरू हुआ है। यू विल सरप्राइज टू नो। अभी हम सब लोग बात कर रहे थे, सब लोग ब्याज की बात कर रहे थे। ब्याज इज ए फैक्टर ऑफ डिमांड एंड सप्लाई ऑफ मनी। हमारे पास, मैं अभी एक फिगर दिखाऊंगा, मेरे एक जूनियर वो दिखाना चाहेंगे बॉन्ड मार्केट के ऊपर। जरा एक वो फिगर डालना है इसके ऊपर।
हाँ जी, वी कैन सी इट।
यस, यू कैन सी। एक ये इंटरेस्टिंग फिगर है, मैं आपको दिखाना चाहता हूँ। इंडिया में हमारा GDP 3.95 है, US में 31.86 है और चाइना में 20.4 है। आप देखिए हमारे पास कॉर्पोरेट बॉन्ड सिर्फ 0.64, US में, ये ट्रिलियन में फिगर है, US ट्रिलियन, US में 11.55 एंड चाइना में 11.15। दैट्स ए कॉर्पोरेट बॉन्ड फिगर। परसेंटेज कितना है? 16%, 36%, 55%। 16% 4 ट्रिलियन का, और जो 12%, 11.5 है वो 32 का, और ये 20 का 5.5। तो हमारा बाजार बहुत छोटा है, बहुत छोटा बाजार है अभी। वो मैं अभी बताऊंगा उस बाजार को कैसे बड़ा करना है। अभी दूसरी फिगर आई है, जो म्युनिसिपल बॉन्ड्स आप देखें, हमारे पास सिर्फ अभी तक 0.5 बिलियन का म्युनिसिपल बॉन्ड्स हैं। यूएस में वो बॉन्ड्स 4.4 ट्रिलियन के हैं, और चाइना में 7.65 के मिलियन बॉन्ड्स हैं। ये जो 4 जो मैंने बताया अपने 5 बिलियन का हमारा पास बॉन्ड है, उसमें मैं नफिट के चेयरमैन बैठे हैं मिस्टर राय, मैं थैंकफुल हूँ। आधे बॉन्ड उन्होंने सब्सक्राइब किए हैं म्युनिसिपल बॉन्ड्स के। आई एम सो थैंकफुल टू हिम। नो डाउट दैट बॉन्ड्स आर गोइंग टू द रिटायरमेंट बेनिफिट फंड्स आल्सो। मैं वापस आता हूँ कि आप देखिए कि जो इंडिया है वो मैं टोटल कर रहा हूँ, जीसेक हमारे पास 2.19 है, और यूएस के पास 36.7 है, और चाइना के पास 13.40 है। आप देखिए मैं इन सब का जब टोटल करता हूं तो इंडिया का जो बोरोइंग है 72%, यूएस का 151%, चाइना का 120%। तो आप देखिए कि हमारे 4 बिलियन में हमने सिर्फ 72% बोरो किया है कलेक्टिवली। यूएस ने 32 के अगेंस्ट में 151%, चाइना ने 20 के ऊपर 120%। जो कई लोग बोल रहे थे कि हमारी क्रेडिट बड़ी बेनाइन है, मैं कहता हूं वो कोई अच्छी बात नहीं है। क्रेडिट बेनाइन होना कोई अच्छी बात नहीं है। जो लोग पैसा ले सकते हैं वो आज पैसा नहीं ले रहे, इसका मतलब क्या है कि वो बाजार को बड़ा नहीं कर रहे। मेरी अगर कैपेसिटी है बोरो करने की तो आई शुड बोरो इट। बोरोइंग से ही बाजार बड़ा होता है। इंडिया की जो प्रॉब्लम है वो हमारी सेविंग रेट जो 18-20% थी, वो ही 20-22% हमारी सेविंग रेट चल रही है। मैं बार बार यहाँ चाइना का मुकाबला करूँगा, उनकी सेविंग रेट आज की डेट में करीब करीब 40% है, हमारी 30% है, उनकी 40% है, और 40% ऑफ देयर जीडीपी। तो इज ए ह्यूज गैप उनकी सेविंग और हमारी सेविंग के एब्सोल्यूट नंबर में। ये सेविंग क्यों नहीं हो रही? मैटर ये है, बाजार छोटा है, सेविंग क्यों नहीं हो रही? जो कौन सेव करता है? अब हमारे बुजुर्ग सेव करते थे, मैंने भी सेव किया। अभी जो पिछले 15-20 साल में हमने देखा सेविंग रेट्स एक जगह स्टेबल हो गई और वो बढ़ नहीं रही, और जो सेविंग होके पैसा आ भी रहा है वो बॉन्ड बाजार में नहीं आया। वो आज की डेट में कई जगह रियल्टी में गया, कई जगह गोल्ड में गया। गोल्ड में मुझे कोई प्रोडक्टिविटी लगती नहीं है, जो भी प्राइस आया हो। मेरा ये कहना है सेविंग रेट से, आज मैं बॉन्ड मार्केट की तरफ से क्यों बोल रहा हूं कि सेविंग जो रेट अगर मैं सेविंग, मुझे भारत में जाना है, कैसे ये बढ़ेगा? मैं बाजार बढ़ाने के लिए कहता हूं, बॉन्ड बाजार कैसे बढ़ेगा? मुझे भारत में जाना होगा। ये हमारा बॉम्बे क्लब है जहां मैंने 90s में दिल्ली से आके कदम रखा, कुछ लोग और भी बैठे थे, वो सब मेट्रो सेंटर्स के लोग हैं। भारत में अभी बॉन्ड गया नहीं। वो क्रेडिट की बात, आज बॉन्ड से बात हम लोग मुकाबला कर रहे थे, बट वो मुकाबला अभी शुरू नहीं हुआ। जैसे म्यूचुअल फंड के डिस्ट्रीब्यूटर्स ने अपना म्यूचुअल फंड बेचा, शुरू में म्यूचुअल फंड फेल हो गए थे, फिर म्यूचुअल फंड डिस्ट्रीब्यूटर लगाए गए। सब मैं 50s में जाता हूँ। सबसे पहले अपने पोस्ट ऑफिस स्कीम आई, वो नहीं चल पाई, उनके एजेंट्स को लगाया गया। उसके बाद 60s में इंश्योरेंस कंपनीज आई, नहीं चली, LIC थी, LIC के इंश्योरेंस आए, एंड ऑफ कोर्स बाद में मैंने बताया म्यूचुअल फंड के इंश्योरेंस आए। अभी OBPP वालों ने एक मांगा है जो कि सेबी कंसीडर कर रही है, वो डेट डिस्ट्रीब्यूशन। डेट डिस्ट्रीब्यूशन हमको भारत में जाके करना है। आज हम विकसित भारत की बात करते हैं, यहाँ से हम बातें कर सकते हैं, यहाँ से हम डेवलप नहीं कर सकते। जो हमको मिल रहा है हम एक दूसरे को दे सकते हैं। हमको इस बाजार को बड़ा करना है राय साहब, उसके लिए हमको भारत जाना है। हाँ चीमा मैम सुन रही है, बहुत अच्छी बात है। मेरा क्या कहना था कि आज वो गांव का आदमी क्यों बचाएगा पैसा? उसको अपनी सेविंग से, आज उसको पता चल गया मेरा इन्फ्लेशन 4% है, तो मुझे बैंक वाला अगर 5% का ब्याज दे रहा है, और वो भी मैं जब वापस मांगने जाती हूं तो 1% का ब्याज घटा देता है चिमा जी, तो हाथ में वो 4% का ब्याज रख देता है। मैं बॉन्ड मार्केट से उसको 7 से 10% का ब्याज देना चाहता हूं, दे सकता हूं, बट मैं अभी वहां गया नहीं। मुझको लॉट ऑफ एजुकेशन देनी है वहाँ जाके। नंबर 1 वो डेट डिस्ट्रीब्यूशन का एक कंसेप्ट हम लोगों ने दिया है, जो मैडम सेबी इज कंसिडरिंग, मैं सेबी मैडम को ही सेबी कहूँगा, बांटता हूँ मैं, तो दे आर कंसिडरिंग इन दैट वे। वो जो सेविंग है जो कि मैं लाया हूँ, वो सीधा एक प्रोडक्ट बनाती है मैन्युफैक्चरिंग इंडस्ट्री पे जाने के लिए। जब तक नया पैसा नहीं आएगा। हाँ, यस,
एब्सोल्युटली। यू नो, आप जो जैसे कह रहे हैं मिस्टर मित्तल और आदिति ने जैसे कहा पहली बार स्टेज पे आए, एक तो वैसा लग नहीं रहा बिकॉज उन्होंने स्टेज ओन कर ली है।
यस, थैंक्स, सो नाइस ऑफ यू। मेरा जो बॉन्ड है वो एक प्रोडक्ट देता है। मेरा एक बॉन्ड जो है वो प्रोडक्ट देता है, वो प्रोडक्ट इनकम देता है, इनकम वापस सेविंग के थ्रू वापस बॉन्ड में जाती है। ये साइकिल पूरा होगा। मुझे इन्फ्लेशन से ऊपर इनकम देनी है, वो मैं सिर्फ बॉन्ड से दे सकता हूँ। बैंक्स की अपनी प्रॉब्लम है, वो 5% पे ब्याज पे पैसे लेते हैं, उनके पास अपने 2-3% के खर्चे हैं। मैं उनको इनएफिशिएंसी नहीं कहूँगा, जो लोग समझें। बॉन्ड मार्केट में अगर मेरे को सीधा इन्वेस्टर पैसा दे रहा है गांव वाला, और मैं लाके उसको बॉन्ड से 9% की रिटर्न दे रहा हूँ, तो वो सेविंग इस बोरोवर के और उस इन्वेस्टर के बीच में पट गई। मेरी जो एफिशिएंसी है सिस्टम की, चीमाजी बढ़ गई। और उसको मन करता है कि मैं इन्फ्लेशन से अगर 4% ऊपर लाया हूँ तो मुझे बॉन्ड मार्केट में पैसा लगाना चाहिए। आप एमएसएमई को पैसा बाजार में दे रहे हैं 12% से 20%, कौन सी एमएसएमई चलेगी? जितनी एमएसएमई अनसिक्योर्ड हैं, नियर डिफॉल्ट पे हैं, काफी डिफॉल्ट कर गई, उनका क्या दोष था? 22%, 24%, 18%, 26% वो उद्यमी लोग थे, यंग जनरेशन थी। आई फील सो बैड जब मैं देखता हूं, मैं उस बाजार में हूं, सिक्योर्ड एमएसएमई चल रहे हैं बाजार में, बट उनको भी 10 से लेके और 18%, 16% का पैसा मिल रहा है। मैन्युफैक्चरिंग कम हो गई है, सर्विसेज इंडस्ट्री को पैसा चाहिए नहीं, एग्रीकल्चर को आप पैसा देना नहीं चाहते, तो इस क्लब में इससे लेके पैसा वहां दे दिया, वहां से लेके पैसा वहां दे दिया, और सिर्फ बात कर ली कि 8%, 9% ये हो रहा है। नया बाजार नहीं बढ़ा रहे। हमारी सेविंग रेट, पराग जी, चाइना से अगर 40% हम लोग अपने जीडीपी को बढ़ाते हुए ले जाएं, कितना बड़ा प्रोडक्ट बनता है। जो मेरा बॉन्ड प्रोडक्ट बनाता है, मुझे सिर्फ इन्फ्लेशन से ऊपर ब्याज देना है, वो बॉन्ड से पॉसिबल है। लेकिन बॉन्ड खाली मेट्रोपॉलिटन से कलेक्ट नहीं होगा। आई हैव टू गो टू मेरठ, नॉट ओनली मेरठ के छोटे कस्बे में। हो सकता है चीमा जी हमको 10 साल लगे, बट हम वहां पहुंच जाएंगे। इक्विटी की जो हम बात करते हैं, जो लोग बाजार के नहीं है, उसकी स्ट्रेंथ सिर्फ डेट है। कौन सी इक्विटी बिना डेट के खड़ी हो सकती है? खाली इक्विटी से आप क्या कर सकते हैं? कुछ नहीं कर सकते। तो उस इक्विटी की बैलेंस शीट में 3 टाइम्स डेट चाहिए, 3 टाइम्स डेट। यहाँ कई हमारे कुछ फिनटेक के लोग बैठे हैं, मैंने देखा पूना से मिस्टर गोयल आए थे। दे आर वर्किंग वेरी हार्ड, नो डाउट। क्या अनसिक्योर्ड पैसे, क्या अनसिक्योर्ड इंडस्ट्री को पैसा नहीं मिलना चाहिए? जरूर मिलना चाहिए। माइक्रो फाइनेंस में बैठे हैं मुद्दूत माइक्रो वाले, जरूर मिलना चाहिए। उनके रेट क्यों इतने ज़्यादा हैं? क्योंकि जो सप्लाई ऑफ मनी कम है। सप्लाई ऑफ मनी हमारे सिस्टम के उससे बन रही है, डेफिशिएंसी से। 30, 35, 40% लोग मनरेगा पे काम कर रहे हैं, उनको अगर हम इनकम दें, कमाई, वो अपने लिए खुद ही सेव करके वापस प्रोडक्ट बनाते हैं। मैं इस साइकिल को समझाना चाहूँगा कि जो देहात का आदमी है उसको सेविंग करने की आदत पड़नी चाहिए। भले ही वो महीने के एंड में 200 रुपये बचाए, 500 रुपये बचाए। हमारे पास 1000 रुपये का भी बॉन्ड है जो हम पब्लिक इशू से लाएंगे। जब वो बैंक में एक दफ़े सेविंग करके अपना डिबेंचर खरीद लेता है, तो वापस हम सिस्टम से उसको 2000 रुपये का लोन दे सकते हैं। M3 हमारी इकोनॉमी बड़ी इसलिए नहीं हो रही, 4 ट्रिलियन के आसपास आप इकोनॉमी को देख रहे हो। मोदी जी कोशिश कर रहे हैं, बहुत कोशिश कर रहे हैं। उनकी अपनी बहुत सारी परेशानी है, मैं समझता हूँ, बहुत सारी बातें मैं भी नहीं समझता, बट मैं ये समझता हूँ कि कहीं ना कहीं हमको छोटी जगहों पर या भारत में बॉन्ड ले जाना होगा। बॉन्ड ही नेक्स्ट स्टेप है। बैंक्स हमको यहाँ तक ले आए, आज़ादी के बाद हमको बैंक्स लाई थे यहाँ तक, बट यहाँ से आगे अब बॉन्ड लेके जाएगा।
Absolutely, yes. And I think audience knows from where my passion comes. And I could see that the room has again become full when my father started talking. But थोड़ा सा बाबा हम मनीषा को भी टाइम देते हैं सवाल करने के लिए.
No, I basically want to know Aditi कि घर में conversations क्या होती हैं? मेरठ जाना है बॉन्ड को लेकर.
Actually में मनीषा यही होती है कि मैं टीयर 1 सिटी में और क्या करूं. अब तुमको टीयर 2 और टीयर 3 जाना है. तुम वीकेंड पे अब जो है थोड़ा सा फैमिली से और टाइम बाहर निकालो और मेरे साथ घूमो. एक्चुअल में यही बात हो रही है आजकल.
हमको बॉन्ड मार्केट को बड़ा करना है. बॉन्ड मार्केट एक दूसरे से पैसे लेने देने से बड़ा नहीं होगा. हमको फ्रेश मनी चाहिए. फ्रेश मनी भारत से आएगा. भारत का आदमी कहता है मेरे को इन्फ्लेशन से ऊपर इनकम दीजिए और जब मैं बेचने आऊं तो बॉन्ड खरीद लीजिए, क्योंकि वो हेल्ड टू मेजॉरिटी नहीं रखेगा. उसको पैसे की जरूरत पड़ सकती है. क्योंकि बॉन्ड वाला कहता है मुझे 3 चाहिए, मुझको प्रिंसिपल टाइम से वापस चाहिए, मुझको ब्याज चाहिए, और अगर मैं बेचने आऊं तो वापस खरीद लेना. वापस खरीदने के लिए मिस्टर उन्होंने बहुत अच्छा किया. रिलायंस वालों ने कहा कि यस, मिस्टर त्रिपाठी जी ने कहा कि हम मार्केट मेकिंग करेंगे जो सेबी करने जा रही है, बड़ी मार्केट मेकिंग. नो डाउट जिस समय वो बॉन्ड बेचने आए तो कोई खरीदार होना चाहिए. सिस्टम को हमने ही डिफॉल्ट प्रो डिफॉल्ट बनाया हुआ है. आज स्टेट लेवल में मैं काम कर रहा हूं 70 से. कई स्टेट लेवल के पेपर लिक्विडिटी ना होने की वजह से डिले हुए. डिफॉल्ट नहीं हुए. एक व्यापारी को डिफॉल्ट करता है, वो मेहनत कर रहा है, उसने डिवेंचर निकाला था, तो अगर उसको हम उसी से पहले एक डिफॉल्ट स्वैप जो आरबीआई ने कभी कहा जो यूरोप में स्टेट्स में चलता है, हमारे यहाँ क्यों नहीं है वो डिफॉल्ट स्वैप, मैं उसका प्रीमियम देने को तैयार हूं. जब मेरे से मैं बॉन्ड निकालूं मैं डिफॉल्ट स्वैप की प्रीमियम दूंगा. जितनी नीचे की रेटिंग है, आपने कहा कि वहाँ यूएस में जापान में कई जगह रेटिंग नहीं है, बहुत अच्छी बात है, बट हमारी मजबूरियां हैं, हम रेटिंग हैं. लेकिन मैं लो रेटिंग में चाहूंगा कि स्वैप के साथ, डिफॉल्ट स्वैप के प्रीमियम के साथ बाजार में वो आना चाहिए. इट्स डिफिकल्ट टू व्हेन आई एम गिविंग दी स्वैप, बट वो स्वैप में थोड़ा टाइम लग रहा है इस डीएल में. एक मेरा दूसरा कहना है कि जैसे डीआईसीजीसी है बैंक के लिए, मैं जो पब्लिक इशू लाऊं और जो कहीं ना कहीं नॉन इंस्टीट्यूशनल इन्वेस्टर आए, डीआईसीजीसी की तरह मेरे पास एक प्लान है. वो है कहीं ना कहीं हम डीआईसीजीसी की तरह अपना इंश्योरेंस ला सकते हैं इसी तरह का. उसको हम कहेंगे फिक्स इनकम क्रेडिट गारंटी स्कीम. उसके लिए एक्सचेकर पर कोई प्रेशर नहीं है. जो इशूअर है वो ही पैसे देगा.
मिस्टर मित्तल, आपने ऑफ कोर्स सारी प्रॉब्लम्स यहाँ पर बताई हैं, अपना पूरा एक्सपीरियंस आपने यहाँ पर बताया और हम कहाँ पर ये खड़े हैं. टाइम आप है, लेकिन एक फाइनल सवाल आपसे जरूर जानना चाहूंगी. काफी सारी दिक्कतें हैं जो आपने हमें एक एक वर्ड करके यहाँ पर समझाई. टैक्सेस की बात हम जब से ये प्रोग्राम शुरू हुआ है तब से यहाँ पर कर रहे हैं. तो टैक्सेस, लिक्विडिटी, अवेयरनेस, रीचिंग द लास्ट माइल, आपको क्या लगता है एज ऑफ नाउ किस पुश की जरूरत है?
मेरे को समझता है हमको भारत में जाना है. मेट्रोपॉलिटन से हम बड़े नहीं हो सकते. हम मेट्रोपॉलिटन में सोच सकते हैं, यहाँ स्कीम बना सकते हैं, रूल रेगुलेशन बना सकते हैं. हमको भारत जाना होगा.
So Aditi, अगर हम numbers यहाँ पर देखें तो what are we getting in from metro cities and what are we getting from tier 2, tier 3 cities?
It's mostly metro right now because investor awareness is very poor. So what we need to do is, of course, we have learned from other asset classes.
हमको एजुकेट करना होगा. भारत में क्यों जाना है? क्योंकि उनको एजुकेट करना है. एजुकेट करने के लिए अभी पहले भी एक प्रोग्राम था. नेचुरली हमारी फ्रेटर्निटी के लोग और एक तो हमेशा तैयार है कि हम जो अपना NISM है उसके साथ मिलकर बड़ा प्रोग्राम करना चाहते हैं. मैं सेबी का बड़ा शुक्रगुजार हूँ जो आपने जैसे सब्सक्राइबर के रूप में राय साहब ने पैसा डाला, बट कहीं ना कहीं बॉन्ड तो निकले. आपने देख लीजिए जो फिगर हैं, अभी फिगर चली गई हैं. म्यूनिसिपल बॉन्ड्स बहुत जरूरी थे. हमने म्यूनिसिपलिटीज़ को कैसे काम करते हुए देखा है. गली मोहल्लों में कुछ असेट्स नहीं थे, बड़ी मुश्किल से बिजली पानी मिलता था. और मैं आज यूएस की म्यूनिसिपलिटी से अपना मुकाबला करूं तो मुझको शर्म आती है. लेकिन चलो प्रोग्राम शुरू हो गया. मैं बोलता हूं शुरू हो गया, ये स्टार्ट है, इसको अब बंद नहीं होने देंगे. यू विल गो टू इंडिया एंड ए बॉन्ड इन एवरी हैंड इज माई नारा. जय हिंद.
Mr. Mittal, thank you so much for that. I mean, that was like a masterclass as we promised you and went very, very well. Thank you. Thank you, Mr.
So may I request you to please stay back? Ladies and gentlemen, a big round of applause for what has already been the session of the evening, I would say. Yes. Moving on, let's talk about building India's infrastructure through bonds. So India stands at the cusp of one of the most ambitious infrastructure expansion stories in the world. And from urban transformation and mobility to public infrastructure and smart development, financing this growth sustainably will be critical to the country's long-term economic vision. And increasingly, bond markets are expected to play a very important role in enabling that transformation. And our next panel brings together some of the most influential voices from India's development infrastructure and policy ecosystem for a conversation on building India's infrastructure. And Manisha is already here. And joining her on the stage are her panelists to talk about building India's infrastructure through bonds: Rajkiran Rai, GMD, NAPWID; Shri Pamela Sunil Kumar, IAS Commissioner, Bangalore City Corporation North; Ajay Saxena, Head of the Public-Private Partnership Cell, Government of Maharashtra; Rajkiran Rai ji, MD. Sorry about that. Sanjay Dubey, IAS Additional Chief Secretary, Ministry of Urban Development, Government of MP; and Praveen Pardeshi, CEO, Maharashtra Institution for Transformation, Mitra.
Well, building India's infrastructure via bonds is something that a lot of us have been talking about for a very long time. And after waiting for very many years, we finally did see that happen. So when you look at India's infrastructure ambitions today, they are larger than the traditional sources of finance. It does need bond markets for that kind of growth, and including into India's finance in sense of country's next phase of urban and infrastructure growth. And that's exactly my first question is to you, Mr. Rai. Have we arrived? Because everybody seems to be saying that, one, we've arrived, maybe, we're starting, but we have seen just so many states and municipal corporations finally reaching out to bonds as the way to raise capital.
Yeah, after hearing Mr. Mittal and the kind of passion he had, you know, I just want to carry forward from there. I think we are at that inflection point. I think the bond market has arrived. Actually, regulators, actually it starts from there. Actually, even though these thought processes are there for long, a lot of committees on this had happened, right from HR committee to so many recommendations. But we see that actually intervention from the regulator now. All the ecosystem is being built now. I think the time has come that the bond market will fund infra growth of the country. There are certain perspectives we need to build on that. See, the Viksit Bharat dream of 2047, 30 trillion economy, we need to simply double our infra investments. So that to happen, where is the money available? Like, you know, if you are spending roughly 15 lakh crores, about 5% of the GDP is being spent on infra now. But to achieve that dream, we need to have 8 to 10% of GDP spent. Now, definitely this cannot come from budget. This has to come from the private sector. So that is where the bond market comes in. So the ecosystem is being built. We are already seeing that traction. Municipal bonds, since mentioned, last year we have seen more than 1,700 crores of issuances. And this year, the kind of discussions I am seeing, actually more than 5,000 crores of issuance is given, and there is no wonder municipal bond issuance will cost 10,000 crores next year. Because there are policy incentives and a lot of urban local bodies are really priming themselves for this issuance. But the bigger piece is on infra, because municipal bond is still very, very small market for our requirement. The infrastructure funding, all centered, none, it is happening through the normal loan market, actually. And once it becomes operational, that asset need to move to bond market. That is what happens in developed countries. So that is where actually the interventions have to come. Now, once that happens, the bank limits will get freed up because banks actually are really tight on liquidity now on the liability side. Infra generally happens in 15 to 30 year bucket. And commercial banks are not natural candidates to lend to infra long-term projects. So today if you see, it is about 34 lakh crores of infra finance book. Out of that is only 12-13 lakh crores which is coming from commercial bank. The rest is coming from the NBFCs and other players like us. Already commercial banks are almost shrinking their share. So now we need to get the bond market in for funding the infra projects. So this is a cycle where the greenfield is still be done by banks because they can assess the risk better. But the operational asset have to move to the bond market. I'll just bring one last point here. Like while it is some time away before the retailers come into this market, right now we have huge insurance and pension fund market. Because there was a slide on financial savings of the country. If you look at the financial savings, 30% of the financial savings is going to insurance and pension funds. Almost equivalent to what is going to the banking. So now their assets under management is growing between 15 to 20 lakh crores every year. But they are not finding way to the corporate bond market. So if the day we are able to bridge that gap, at least 4 to 5 lakh crores of money from insurance and pension can flow to the bond market, and that will address our requirement of infrastructure need for the next 4-5 years.
You know, Mr. Rai, NABFID was basically created to strengthen exactly this. What do you think is the biggest financial gap that still needs to be covered? I mean, you've given us all the numbers, right? But where do you see the problem now coming in from?
Actually, you know, there is a perception issue. We can call it recency bias. Like the whole investor class, including many of the lenders, feel infrastructure asset is a risky asset. I had a rating agency person
Are you
here.
adding governance issues to that too?
No, there are no governance issues. It is a risk perception.
Okay.
Because generally the default rates were quite high between 2014 to 2017 period. We studied about 2,500 rated infra companies. The default last year was only 0.3%, lower than your housing loan market. So the perception has to change from the investor community about the infra asset class. This is solid asset class. Governance issues we had seen earlier. I think the regulators have done a great job in fixing those issues. We don't see that. Today, as an asset class, it is performing very well. The perception has to change. And till that happens, we have come with a product called credit enhancement, where we are likely to do a transaction shortly actually, where the A-rated entities, actually there are a lot of discussion in the previous panel also on that, A-rated entities or BBB rated entities, we will credit enhance them to AA. Because asking insurance and pension funds to take BBB or A asset is a long story, it is difficult. They will look for AA. But we will make these bonds AA by first loss guarantee, credit enhancement and all that, so that they can subscribe to that. So we have already started these interventions, we are building this market. So once that happens, in the next 1-2 years, we will see the BBB and A issuances coming to the AA enhanced rating, and then the bond issuance happening. We need to do some work on some changes required on the insurance regulations and pension regulations. We are working on that. Even credit enhancement product from the RBI, last year only the new guidelines came actually. We worked very hard for getting all that modifications done. Now the product has become really cheap. Now we need to do some publicity for credit enhancement products so that this can really do that. But NABFID is doing its role in developing the bond market.
Mr. Sinha, let me come to you then. And when it comes to urban and infrastructure development, and municipal bond details means slightly smaller in that area, where to ensure that we do not stress the traditional sources of finance too much, what do you think needs to be done, and how far have we come? Where are we headed from here?
A very valid question for when we are looking at the bond market financing the municipal infrastructure. To be very frank with you, as of now, if you see the whole spectrum of the bond market financing, it's about 5,000 crore worth done in last few years, versus the budget size of all municipal bodies in a country like India would be around 2 lakh crore. So it's a very, very minuscule, I would say, a drop in the ocean as far as the bond market financing the infrastructure for the municipal bonds is concerned. But that does not, should not deter us in assuming that there is not enough opportunity for the bond markets to happen. In fact, there is a lot of stress now by the government of India giving opportunities, not only opportunities, but to also certain extent subsidize to encourage the municipal bodies to come forward and go to the bond market. It's not per se the money that we will be able to raise through the bond. It is the discipline which has to be inculcated into the municipal bodies. It is the governance issues that we need to address once we are doing this. It is a trust issue that we have to do it. And it is also the ownership issue when we talk about municipal bond, that every individual who is a citizen of a particular locality is also a stakeholder into that. If we bring in these kind of trust issues taken care of, and the governance issues taken care of, I don't see that there can be any challenge to the bond market, be it a subsidized or any encouragement given by the government of India or the state government or not. It is essential, and as Mr. Rai has pointed it out and Mr. Mittal was saying, that if we have to grow as an economy and we are aspiring to be a 30 trillion economy in 2047, we need to work on financing the infrastructure. And this will come from urban development, not from the areas where you don't see these kind of things. So there is enough sufficiency, there is enough appetite. Only thing is we need to have our structures in place, and we should have the situation whereby we are able to utilize that money for the productive use of an assets creation. If we don't use it and fritter away these chances, I'm sorry, and I'm afraid that this will be a missed opportunity for infrastructure development and a growth of the country.
Mr. Mittal was also showing us all those numbers there, and we are really small in comparison to various other countries there. But when it comes to infrastructure and urban development for that matter, and of course the Viksit Bharat and the kind of plan that India is looking at, what are the sectors and subsectors that you would want to form for us to ensure that we achieve those kind of numbers?
Can you repeat the question?
I was asking what really needs to be done to ensure that there is financing happening via the way of bonds.
I mean, now I represent the Bangalore City, Greater Bangalore Authority, which is split into 5 different corporations. I head the North City Corporation. So this time we have actually planned to raise 1,000 crores of municipal bonds. Sounds ambitious, but then we are starting with that. And we are going to invest this in the major infra project, so elevated corridors. And we are actually looking into the value capture financing. And we put some impact fee and then surcharges of that area where people get a lot of benefit. And that's how we are planning to recover that. And then coming to the repayment, we have certain plans. So 10 years back, I was commissioner. I've never heard of these, municipal bonds and going to the market and raising funds from the market. But after that, after 10 years, now if I see, there's a lot of confidence in us that yes, it can be done. Looking at the market, that we can generate the revenues from there. And in the last 10 years, government has done a lot of reforms in urban areas. There were schemes linked to the reforms. Without reforms, you don't get the funds. So we are forced to do certain reforms, and we are getting prepared for this, and it's exciting.
If I may add to the reply that he has just given, we need to have innovative projects taken up. We have to have an innovative structuring of our bonds, and we have to have an innovative use of it. Most of the time you would see it's essentially either on as he has mentioned, on the infrastructure, which is like roads, bridges, culverts, etc., etc. I just want to take a minute explaining there are 2 very different kind of bonds that we are looking at from Madhya Pradesh government. One is temple bond. Nobody has ever heard of temple bond coming up. And today we were in discussions with SEBI, Mrs. Chima, we were having discussion with NAFED, Mr. Mittal. What we are coming up is, we are wanting to create infrastructure development in and around the temples in Ujjain, in Mahakaleshwar area, where we are looking for a Kumbh to come in 2028. We create infrastructure, we create experiences for the pilgrimage, and from the donations, we would repay the bond money. Now, this is already in place. We have our merchant banker in place, we have the rating agencies in place, and we have sufficient money right now sitting with us in the form of FD in the form of continuous donations coming in, which we want to fund it. So that is one product that we are coming into the market, and I am sure that there is an appetite for that kind of a thing. The second innovative project that we are coming up in Madhya Pradesh is a pooled finance for a floating solar battery storage project to be used, the generation to be used captively by our municipal bodies. Now, one of the reasons why municipal bodies are not able to raise bonds is because they don't have a repaying capacity. In this product, when we pay per unit charges to the distribution company at a rate of 7 rupees, instead of that, I'll be paying around 3 rupees 50 paisa. And from the savings that we earlier used to pay, we will be able to repay the bond money as well as to pay to the developer. So if we go by these kind of products, and we will be able to tap the subsidy given by the Renewable Energy Department on the floating solar with the battery storage, and we'll also be able to tap onto the subsidy that is being offered by the Government of India, Mahua. So the idea is that if you have that kind of products coming in, I am sure that there will be enough market available. We just have to create that bouquet of opportunities for a retail as well as private investor. And by the way, these are going to be public issues. They are not going to be private issues. So we want every investor, as Mr. Mittal was saying, we need to go to Bharat. We need to go to every village. We need to go to every individual who can be a partner into this development.
Oh, very, very well said. Because we're moving on from urban infrastructure to temple bonds and green bonds and renewable bonds and whatnot is coming. What is your sense now? Because we're looking at more and more states coming in, and thematic bonds, do you think, is the way to go ahead?
This is very interesting. So I've been to Madhya Pradesh a month back, and I heard about this, and this is very innovative. The message, the underlying message, everybody should understand. When what Mr. Mittal said, what Sir said, what he is saying, we are in a habit of taking loan for a purpose without structuring the purpose back to the repayment. Okay. So the purpose is served, and then the repayment is happening because of various things. So mostly cities in India, I don't think barring 4, 5, 10 cities maximum would be thinking in a manner that if I have taken a loan or if I have raised the bond, I will repay it. They will depend upon the government funds, and the budget would be there. Many merchant bankers and the many financial institutions would be here, and they will proudly say that we have structured the borrower's balance sheet in such a manner that the credit has enhanced or something. So it is again, they will be talking about the balance sheet. So mostly we are doing this thing with the balance sheet financing. Till the time we make a departure from the balance sheet financing to the project financing, we are going nowhere. Because the project financing is what is to be stuck. Means we have to go deeper into the project financing rather than only looking at the balance sheet and raising the fund on the name of the entity, not on raising the fund. And you would see these things. There would be many people who may agree or disagree with me also, but I have seen in my life that the project would be aligned with would be stitched to the bond name, but no, and there would be balance sheet prepared, the cash flows would be prepared, futures would be there, but there would be nothing. This would be coming. Let's say water project is coming in Pune and they are raising a bond. I don't know any water project would be able to fund itself if the capital expenditure or something is to be done. No city, because this is not a road that if I don't pay a toll, you would not allow me to go. If I am thirsty, you have to feed me the water. Okay, the water is not that if I am not able to pay the water tax, you will just cut my tap line. You can't. So when we are talking about the municipalities, we need to understand, first of all, yes. So what Sir has said, what Mr. Dubey said, that yes. So if he is looking at the funding certain infrastructure around a project. So let's say temple was a theme. So there is a project, and then I'm structuring. Then there is a religious tourism which is happening. Then there are people who are contributing to to fund that activity. They are doing the donation. Okay, the donation is again not a stress on the balance sheet or the government, and not on the city's balance sheet also, and it is funding itself. So people are going, people are paying. Now these people are paying only from the unstructured, informal ways of paying as per my capacity. I am paying my donation and I am paying my respect to the God or whatever the form we have derived at. But when it comes to the structured market, I don't know, I don't see any people, like I have just arrived only an hour back or something. I have not heard, many people may have said it. But even in the country, if you go to the bond market, first of all, first thing is sure, the excitement is there to issue the bond. Okay, to that much excitement I can see from 2016-17 onwards, when that bond subsidy, the interest rate subsidy had come. But after that, when the bond goes to the market, I was part of one bond which was being bidded out in the stock exchange, and there were two banks who were bidding against each other, and finally one banker bid, and then the commissioner called the other banker, no, my deposits are in your bank, why don't you bid it? And he bidded it. So it is again the bank finance. It is nowhere the people financing the infrastructure. So it is the bank finance come in the form of bond. Till the time, I think we all are understanding this, that the individuals have to come to this thing. So when this goes to the individual people, then only the things would survive. If you take it to the masses and the masses start funding itself, like tolls. Tolls are a classic example of anything successful. Airports, we can understand, anybody who is going to the airport may not be able to see the charges I am paying to the airport operator or the airport authority. But if I am passing the road, I know that I am paying 30 rupees toll, and then also people are paying. And that is what is making it successful. We come back to again annuity, then annuity is again financed by the banker, and the bank is again by the depositors. So we are into the loop. We have to come out of this loop and we have to take it to the masses. This is the question on the thematic. Yes, theme, I treat it as a project. If anything you do like this, I wish sir a very good success on this, because this would be something that the people would be coming and paying for something. And when the people come, when the masses come, this becomes successful.
So municipal corporations clearly and states seem to be raising quite a bit of, at least they're getting in, they're preparing, they are aware of this now. But Mr. Rai, the repayment part, now let's just come to that, and not each project perhaps or each bond repayment may be as easy. And I'll come to you with that as well after what the points that he has raised there. But what is your sense on this?
See, it is, we should not be generalizing all fundraising like this. Because today, solid waste to power. There is a power purchase agreement with the electricity board. It is self-financing. So we have funded many of these projects. Solid waste to gas is another thing. Public sector bodies buying the gas. So these projects actually municipal bodies can do without their balance sheet also. Because this will be PPP projects and they have to only structure it right so that the solid waste reaches that point. So there should not be any issue around that. And then the PPP, the party takes over. Similarly on the treated water. Now any thermal plant is supposed to use treated water from a nearby town. Now actually we have funded these projects. So they pay for the water what they get. So now actually these are all self-financing bodies and all that. So there are very few general issues on the issuance on the balance sheet. Now when we talk of temple fund, morning I was with Mr. Dubey sir. Actually they have structured it so well. The assets getting created out of this fund, they are revenue generating. People pay for the use of the facility they provide, and that money gets escrowed. Now, all the municipal bond, Mr. Mittal also works on that, the revenue streams are being escrowed to meet the repayment. So, it is not very generalistic thing of earlier times. Now, today it is better structured. We have learnt our lessons. It is not on the balance sheet of any urban body that they collect money and pay. Every project is sliced in such a way that the revenue streams are very distinct. He spoke of the solar project. And what happens is a PPP player comes in. They do the all facilitation. And then that fellow will sell the power. And that revenue stream will repay the bank. So I think it is structured well. And see, there are issues around urban local bodies. We are looking at a domain of at least 800 local bodies which are capable of borrowing. Because again, I mentioned a number of urban like infrastructure need of the country for 2047. There is an estimate, the requirement is 770 lakh crores. Out of that 350 lakh crores, nearly half of that is supposed to be spent on urban infra. If this is the number we are looking for 20 years, then urban infra, how it will be funded? It will be through this bond market. So, and it will be project specific, it will be properly escrowed, giving safety to everyone. See, generally this, I said the perception issue in the beginning. So many of these are because of our bad experiences of last decade. Now things have moved on. Actually, today every bond issuance is structured very well.
So let me come to you with a final question on exactly that. You made your point that sometimes it's self-finance, it needs to be structured better. You have to ensure before you launch a band on how you're going to repay it, and then of course it is about toll system and etc. There are various ways to do it. Let me start with you since you're holding the mic then. What is it, and we have 2.5, 3 minutes to wind this down. What is your sense? What is it that you would tell a municipal body, corporation, on what is that one thing that they should keep in mind to make their issuance a success?
I think sir has already mentioned, urban local bodies have a serious governance issue. Actually, they need to fix because their accounting standards are very, very poor. The balance sheets come out after 3 years. The bond market will not accept all this. So urban local body has to get their act together. They have to collect their revenues like property taxes, water tax in time, and once they do that and put a proper balance sheet, and once they issue a bond, then there is a commitment actually. See, there are 22 municipal corporations who have issued bonds till date, and some of them are repeatedly doing it. And they are very successful in issuing bonds, and last year at least 7-8 new urban local bodies like Agra, Varanasi, Allahabad, these are the bodies who came for the first time. Small issuances, but they all came. So now that means they have fixed their governance issue. In a way, indirectly, by issuing bonds, they are fixing their governance issue. Because otherwise SEBI will not allow them, because they have to come with their balance sheet. So that's why, in an indirect way, we will force them to follow governance standards.
Yeah, you have to be transparent in our operations. There is a little bit of opacity when the investor wants to come in. Adding to what he has already mentioned, because unless we have transparency in our operations and the people are able to see as to where the money is going, people will not have, or the citizens will not have confidence into getting into the bond market, because everybody out of the way would ultimately will look at whether he is going to get the money back what he is making the investment. And I feel that SEBI and I would say NSE, the exchanges have done a tremendous amount of job of facilitating that. For the first time, the SEBI is allowing pooled finance, because not every municipal body will be able to get into that level in a year or two. And that is why we are looking for a pooled finance in Madhya Pradesh, that everybody has to prepare their balance sheet. They have to come and become transparent in their operational issues. And once they are able to do it, they will gradually graduate to a level whereby they can separately or alone, they can go to the market and raise the fund. So I feel that there is a lot of things that is being done at the government of India level, the state government level, and it is now turned for the municipal bodies to become transparent in their operations. And once they do that, there is no dearth of money coming.
Back.
Yeah.
Okay.
So one thing, I think we touched upon that public-private partnership also. And yes, this is like an if economic revolution has to come, it has to come through the alternative financing. Public-private partnership remains the key. We cannot do everything possible from the government money or the taxpayers' money. User money has to come. For the user money to come, for the private sector to come and participate, the one thing, if I have been noticing for almost 20 years of my services in PPP alone, payment security system from the municipality has to be robust and should be very, very clearly visible. And even if the project is not able to finance because the tariff rate cannot be, or the water cannot be raised volumetrically or something, at least some revenue has been escrowed to repay the concessionaire. Same would go for the bond. If the municipality is good enough in doing their good construction on time, because PPP is not only about the alternative financing, it is about the alternative management also. So if they are able to do this, then PPP costs you around 12 to 13% on the WACC terms, on the weighted average capital cost. Your municipality can do it at 7 to 8%. And with this 7 to 8%, the same as mechanism, if you can evolve, you can repay your fund, you can repay your loan, you can do your things. One thing I would like to tell, if the city managers are here, Bangalore is already here, sir is already here. The countries are known by the cities they have. We know Paris first, France later. Okay, so if we have to grow in the country, the cities have to grow. And the cities have to grow, the finances have to be secured and also robust repayment mechanism. For that, a payment security system even if it is to be some kind of a guarantee from the state government or from some kind of an entity which is created, or the credit enhancement that he has talked about. There are various tools available. There is so much of intelligence and the knowledge here in this room. They all can work out, but this is to be ensured.
Very, very well said.
So on the repayment, I want to say one thing, that while the fund raised from the market is invested in one project, immediately I need to do the debt servicing. So if you understand the municipality fund flow, the property tax collected is first the statutory deductions are done. Then the next step is running the institution, the SWM, the solid waste management, street light maintenance, and the road maintenance. Then whatever is left goes for the welfare, and then whatever is left goes for general development. So in these stages, where you take this debt servicing is very important. If I take it after running the institution, nothing is left. So probably after the statutory deduction, that is cess, library cess, beggary cess, immediately after that, if you can make this mechanism of accruing this fund for debt servicing, this will definitely succeed. We have come a long way. No corporation, big corporations at least, in a situation where they cannot run the show. At least they have to run the show. To run the show, a step before I would have paid my debt servicing, I would have done. So this way we can plan, and this is workable, I see. Thank you.
Well, this was easily my favorite panel till time here, and a great knowledge sharing here. Thank you so much, gentlemen. So much work being done, and municipal financing, or rather the infrastructure and urban way of raising funds now via bonds is something that really needs to be growing here. Thank you so much. Really appreciate your time. Thank you.
Thank you, gentlemen. Thank you so much. I request you to stay back, Manisha. All right, we move on, and we shall talk about why is India Inc. turning to bond markets. So as India's capital markets deepen and financing needs to evolve, more companies are increasingly turning to bond markets as a strategic avenue for enabling long-term growth. From NBFCs and financial institutions to real estate and corporate India, the role of bonds in business financing is becoming more significant than ever before. And to decode why India Inc. is turning to bond markets, please welcome Sadaf Saeed, founding CEO, Muthoot Microfin; Sachin Pillai, MD and CEO, Hinduja Leyland Finance; Parag Sharma, MD and CEO, Shri Ram Finance; and Preeti Cheda, CFO, K. Raheja Corp Investment Managers.
Thank you for that, Mugdha. Well, moving from one very important subject to another one, and this one is why India Inc. is turning to bond markets. For the longest time, we have known that bank financing remained a default mode for the companies, but we really seem to be moving on for long-term sustainable capital requirements of companies. And Sadaf, let me start with you on that one. For a company like yours, which is into microfinance business, first of all, how are you approaching bond markets? And do you think a mix of equity and debt is something that the industry needs to be working on from here?
Oh, first of all, thank you very much for inviting me here. And Manisha, it's a very important topic. I think if, as far as institution like us is concerned and NBFC industry is concerned, the primary reason for accessing bond market is essentially focusing on diversification of sources of capital. Banks have supported us till now, and I think banks play a very important role in terms of providing finances for us to lend to the end customer. But increasingly, we are focusing on diversification of funds. So in that kind of our effort, bond market plays an important role. It not only helps us in diversifying, it also helps us in ensuring that our ALM is better. Because typically bank funding is coterminous to what loans we originate. But bond financing could be longer tenor, and it allows us a little bit of flexibility and allows us to negotiate better. So it helps in a multiple ways. It's a longer tenor. From that perspective also, you can have an asset generation which could be a longer tenor. So it really helps. I think the most important aspect as far as the market is concerned right now, the interest rate transmission in bond market is slightly faster as compared to the banking channel. So I think that also in a declining interest rate scenario, it works well, that you can reduce your cost of fund by accessing the bond market and issuing bonds there. So that is the primary reason there.
Sachin, this one is to you. And then, NBFCs are increasingly seeing diversification, especially for a liability management as a criteria. How would you approach bond markets?
Good evening to all, and thanks for having me around. Yeah, I mean, historically, if you look at NBFCs were bank funded, and over the last, I would say, 1.5 decades, you have seen NBFCs moving towards capital market. And prior to what we saw in 2018 post ILFS DHFL thing, you had better rated NBFCs having larger concentration of capital markets as compared to banks. And obviously the reasons that Sadaf was mentioning was playing out. We did see a contraction of that happening post 2018-19 and COVID, where again banks became dominant. Obviously, what happened in 18-19 and the fact that, I think the overall limit for which SEBI had for NBFCs, mutual funds to especially invest in NBFC papers was brought down, and that also played an impact at that point of time. However, I think over the last few quarters, from 2023 onwards, we have again seen bonds, kind of picking up. In our own case, what has worked good for us during the same period has been the fact that, we had a 2-notch upgrade which came in. So now what we were in 22, 23 or AA minus, we moved up to AA plus. So that has also helped us in, beefing up our NCD and other instruments on the capital market issuances, and that has helped us in diversifying. Also, I think philosophically for NBFCs particularly in the erstwhile period, it was all about efficient liability management, was all about getting it at the lowest cost. I think that has moved over the period, especially we have seen what happened in 2008-9. One external event, credit crisis. You had NBFCs dominant on short term, but deploying long term, going for a toss, and you almost had 5 to 6 months of no funding happening from NBFC. Then you again saw the repeat of that in 18-19. Because of the domestic, issues of ILFS and DHFL, again, NBFCs who were high on short term, had to kind of, take a breather in between, and that. So I think, it's kind of, learnings are there, in that sense, and given the asset class focus each one of us have, I think, not only from a diversity perspective, but also from a ALM perspective, we have better flexibility when you look at it from a capital market perspective to match off your liabilities to your assets as compared to what, here I'm primarily comparing it with bank funding. So, that has kind of helped us, and I feel this, what we are seeing, the trend of diversity getting created and more, issuance is happening, especially from NBFCs, would kind of continue as we go forward.
So while of course the markets are or the companies are looking at both ways in sense of financing, and that is exactly what they see going forward as well. Preeti, this one is to you. Over the last few years, when you look at the overall market, structures like REITs and InvITs seem to be expanding when you look at financing, especially in real estate and other sectors as well. How have you seen this grow? Where do you see the gaps and where do you see the way forward from here?
Right. Good evening, everyone, and thank you for having me here. So obviously, historically, we had equity, we had debt. And there was one gap which was lying between the two. That's the gap which REITs actually have, REITs and InvITs have bridged. So this is one instrument which is giving you, in a way, the best of both worlds. So it's giving you regular income as well as growth. And if you look at the history, it's been a short history. It's not too long. It's been about 7 years since REITs have happened and maybe 9 years since InvITs have happened. So within the 8 to 9 years, I think it's gained considerable traction. Today, if you see the assets which are being managed between the two instruments, it's almost up of 10 lakh crore. So that's the feat we've achieved in the last 10 years. Even in terms of returns, people kept telling us, when we actually go and talk to equity investors, say, oh, the returns don't compare. And when we go to debt investors, then debt investors say, oh, there is too much of equity kind of risk. So that's a battle which we kept fighting all the time. But now if you see, this is one instrument which remain moderate risk, moderate return. And I think 15% plus return over the last 6 years on an average across the REITs has been, I think, a considerable feat. I think, and this is one instrument since we are talking about in terms of the placement also. If you see today, we have mutual funds, insurance, pension funds. Everybody has invested in these instruments. And it has come across various funds, balance funds, debt funds, equity funds. So this one instrument which has actually fitted well in every bucket. Even from a debt perspective, when we talk of the funds, these are, construed as high yield debt products, to some extent. So to that extent, you have actually money coming in from debt and credit funds also. Balance funds, obviously, we match. Equity funds take us because we are a hedge against volatility. So in a way, we've been ticking all the
right boxes there.
Yeah.
Okay. The other thing, Preeti, that our market talks a lot is about the fair pricing of these bonds, especially when it comes to green bonds, whether that, of course, if they're ticking all the boxes in sense of ECG and governance, etc.
Yes.
But when you talk about the pricing of it, how far have we come on that?
So I think today, if you look at most of the REITs, historically when we started off, all of us had bank funding at the SPV level. So we are a two-tier structure. All the funding started with bank, but if you see now the way it is progressed, most of the funding has now moved from the SPVs to the REIT through bonds. So today, if I were to give, say, Mindspace as an example, when we got listed, we had 4,000 crore of SPV level bank funding. Today we have a 13,000 crore book, of which 9,000 is bonds, and 4,000 still remains at the SPV level. In terms of pricing, there's clearly almost, I would say, 50 to 75 bips gap between what we get at the SPV level versus what we get. Of course, keeping some ablative periods aside, but otherwise that's the kind of pricing. And as our co-panelists said, flexibility is something which we have also realized in terms of raising funds. Of course, we've done a lot of green funding also, so that's also been an added advantage. But overall, we've seen a lot of flexibility and a larger, I would say, avenues, because we have pension funds, mutual funds, NBFCs, everybody investing into these bonds. So I think that's really helped the industry.
Sharma, this one is to you then. How would you look at the retail participation coming into this space now? Because that is something we've been talking about. It's small right now, but the OBPs clearly do help that. How are you looking at the growing NCD appetite, issuer activity across all of these sectors?
I think we are a deposit-taking NBFC, and we have seen largely retail deposits, which is sizable. If awareness is there, there is no reason why retail investors will not put in money in bonds. Mr. Mittal was talking about rural India, Bharat participation. We are getting our deposits largely from the tier 3, tier 4 towns. So there is no reason, if the awareness is there, if credibility is established. As of now, what we see is even the largest investors, be it funds, be it insurance companies, they are averse to lower rated instrument. In that scenario, to anticipate and expect retail investors to invest in lower rated instruments will be a challenge. But yes, if the rating is good, we should reach out, and there is no reason, if the awareness is there, retail investors will not put in money. For them, as Mr. Mittal was putting it, others have also put it, if you are able to get a better return than what you get in bank deposit, there is no reason why they will not participate. There are challenges. You need to have demat account. You need to be getting information on various platforms is available, scattered information. Challenges are there. But if the deposit is an indication, there is no reason why bond investment should not come from retail market at all.
So would you say that the corporate bond market is finally entering a more mature structural area from here on?
I think the sheer volume of overall corporate bond market, and slowly we see on a daily basis, on a month-on-month basis, the participation of retail which is coming through. There is no reason in next 2-3 years it will be a very different scenario altogether. We have been talking about deepening market. I think if we look around, then we talk about different countries, what efforts they have taken, be it partial guarantee, be it liquidity providing, be it bank supporting in some other countries. I think there is no reason why India should also not be able to evaluate that. It should be definitely possible.
All right. So next 2 to 3 years, perhaps you could be looking at bigger numbers. But that's exactly the question I want to ask all of you. Satif, what's your sense? Retail participation and the corporate bond market maturing. How would you look at both of these? And what's your sense, as Sharma said, next 2-3 years perhaps is a better number that we can aim for?
No, absolutely. I think our bond market is evolving. Of course, the size compared to US, we are pretty nascent stage, but 59 trillion rupees is not a small sum. Year on year, like last year being around 13.7 trillion, and prior to that around 14 trillion bond issuance. It's a good number, sizable number. But I think the crux of the problem is on the secondary market. I think primary market, there is enough interest we have seen. Retail is coming in. I think private placement is predominant participation right now. Retail needs to come a little bit more. Retail issuance is 9,000 to 10,000 crores. I think that is to come. Plus, I think the most important part is the liquidity and the secondary market. That is very, very important. I think as compared to other developed economies where around 40 billion worth of money gets exchanged on a daily basis, I think that is where I think our market is lacking. But not to say that we are far away from that. We can do that to the extent of our size. I think there are few important steps that we need to take. And I think Mittal Saab also alluded to that. There has to be awareness and education of the customer. Bond should not be only merely like, especially from a retail participation, and when we are talking about dealing with Bharat, there has to be understanding of the risk, the credit risk that is with the kind of the product that is there, liquidity risk that is there, interest rate risk that is there, and like overall issuer risk that is there. That has to be understood first completely. Secondly, I think the most important aspect is rate should not be the only kind of a reason for determining A bond from B bond. I think you should look at risk adjusted rates, and then you should decide on what bond you should subscribe to. The third most important thing is transparency. I think it is from the issuer side also. We had a panel where municipal bonds are also coming in. So I think the more structural and information that is available to the people who are participating in the bond market, more would be the confidence and more they would be trading. I think it's in the interest of the entire market that there is greater transparency, greater understanding of the risk associated with bond. I think if that happens, definitely our secondary market will evolve faster. I see that happening, as my colleague said here, in next 2-3 years, because as we see the new generation which is coming in, they have a more risk appetite and they will be able to participate in this segment a little bit more.
How would you look at the retail participation? And do you think it is the younger generation participating better? I mean, I don't agree with that, but what's your sense?
Yeah, I mean, if you look at it, all the important indicators, like for example, if you look at bonds typically in India is still a AA above rated papers, right? You don't see anything below that. And with that, whatever yields that you get, and again, if one has to look at it from a fixed income perspective and equate it to, say, deposits, it's better than what you can get as far as bank deposits is concerned. Second, obviously, younger generation is more tax aware, and obviously, beyond a certain limit and a tenor, it comes under a long-term capital gains rather than fixed deposit interest getting into a normal tax slab. So that again, kind of is a plus. And over a period, we have also seen that the literacy levels on this side has gone up. So bond is not seen as an unknown kind of an instrument anymore, and that's what possibly is driving the retail participation, which is considerably going up. We have also seen issuances going up. Earlier bond issuances used to be with some few blue chips in each of the segments. Now, last year we saw almost 1,900 bond issuances. So issuances, numbers are going up, and with that, the overall subscription, you have also seen retail subscription, moving pretty fast in many of the bond issuance. So these are all very clear indicators that, it is becoming a valued, investment, opportunity is how that's been looked at. But the issues that both, Pradeep and Sadaf mentioned in terms of secondary, market, most of the retail investors, I think, still would be holding it up to maturity for liquidity to come in. So that is something which possibly needs to change. And yeah, our macros in terms of relative to GDP, we are still much away from even our South Asian peers as compared to Libya and the developed countries. So these are all things which I feel, the momentum has started, and you'll see this picking up. And the way we have seen, even as it rightly pointed out, the investor education part of it, and that literacy part of it becomes very important. We have clearly seen how the AMFI campaign on mutual funds has a correlation to how SIP investments have gone up. So something similar, and here I feel it is more incumbent on issuers like us, a responsibility coming in to have that education and transparency built up, will go a long way in terms of the retail participation numbers picking up going forward.
Preeti, what's your sense? And also, from being a niche lending segment to where it stands right now, would you still call it niche, or do you think it's evolving better than that?
So I think it is clearly evolving. Even if you look at the numbers, obviously retail participation has been very poor. Out of the total issuances, just about 2% is coming from retail. Otherwise, it's largely institutional participation. But at least if you look at the statistics in H1 FY26, the 2% actually moved to 5%. So that's almost more than double the growth. I think, as everybody said, awareness is going to be very critical. Transparency, which of course SEBI regulations over the last couple of years also have evolved in terms of the transparency disclosures, that's also helping. Recently, even last year in 24, they reduced the size of investment from 1 lakh to 10,000. Now, all of those are positive steps which I believe going forward should help. And I think from an economic perspective also, it's very critical that you have savings getting channelized into bonds, because that's also healthy for the economy as well.
Sadaf, we seem to be talking about tokenization and derivatives right now. We're calling it niche even as it is evolving. And of course, as you said, there's way more awareness, way more transparency that is still needed. Are we ready for the newer products?
Yes and no. I think, of course, innovation is needed because you need to kind of cater to demand of different types of investor, definitely, and the products that are available globally, derivative, the swaps that are available. I think if they are there, it makes the product more affordable for a lot of people. But at the same time, I think at the basic level, if we need to widen the market and broaden the market, I think then education is first step, and then of course broadening and going to innovative stuff. I think I'll again go back to one of the stuff that Mittal sir said, and we are talking about Bharat participating into the bond. Microfinance, which I represent as an organization, fundamentally started from SHG savings. So the self-help group first saves the money and then it lends to its members. So that is the way it is. So they have the nature of saving. And if you look at the amount of money that is lying in Jan Dhan account, almost 3 trillion rupees, so they have the money to save. I think if that can be channelized somehow into the bond market, which is relatively safer in terms of less riskier, so definitely it can help bond market to mature. I think to answer to your question, innovation, yes. Awareness, maybe more priority.
that perhaps goes hand in hand. But your final comments really, how would you look at the bond markets from here on, let's say next 10 years, and what would you say needs, very, very strongly on a priority perhaps to get there?
I think priorities are well set. Retail participation has to come in. Diversity of rating should be well accepted, and investors should look at different rated the way it has been done in US. If US bond market of AAA is less than 5% and it is more for lesser rated instrument, that is how it should phase out. That is how countries should adopt to the bond market. And we are very positive. I think there has to be innovation. To the retail investors, don't complicate, as what he is saying is right. Give them a vanilla product. As and when it matures, acceptability is better, then only look at innovations.
I was having a conversation last year perhaps, and this was about Indian participants know more about crypto and less about bonds. Is that about to change?
Can you just repeat it, what you said right now?
I said a lot of conversations that I was having last year with a lot of investors said that Indian investors know more about crypto than about bonds. Is that about to change?
No, my thought goes back to what Sadaf was saying, and also Pradeep. I echo that same. You need to get the basics right, and have the coverage coming in. There's a lot of investment which can happen in the tier 3, tier 4, and therefore not getting into crypto derivatives, etc. Keep it simple. Broad basis. The country has the potential to do that, and then kind of move up the value chain would be my thought process on this.
Preeti, your final comments on this. And the statement, by the way, was sent by the SEBI chief.
So I think today if you see bond market is largely limited to AAA, AA issuances. I think that needs to correct. We need larger access there. And I think the most other important thing is liquidity. That Mr. Mittal also said that. So I think that those are some of the key things which need to be addressed. Market making, of course, is going to help. So I think once these are done, you'll create more depth in the market, which is, I think, need of the hour.
All right. Thank you so much, gentlemen, and the lady for joining in. So clearly we are here to grow. The markets look very ripe for new products and more new participation as well. It's about awareness, going to Bharat, and clearly keeping our governance and transparency on. Thank you so much for your time. Thank you.
Thank you to all our panelists. Manisha, for steering the conversation. Can we please have the Grow Billion Trees certificates for all? Thank you, Manisha. All right, moving on. At a time when equity market euphoria continues to dominate investor conversations, the importance of balance, diversification, and risk management can often take a backseat. But seasoned investors know that long-term wealth creation isn't built on excitement alone, it's built on resilience. So where does fixed income fit in this modern portfolio story? Let's find out. Our next panel will help us understand that what lies beyond the equity euphoria and how to build balanced portfolios with fixed income. And to lead this conversation, let us welcome CNBC TV18's Nigel D'Souza on stage. Hello. And joining Nigel, Santosh Kamath, President and CIO, Franklin Templeton Alternative Investments. Vikas Jain, Director, AK Capital Services. Harini Anand, CFO, Geo Credit. And Gopal Jain, Managing Partner, Gaja Capital.
Check. Hi, good evening, everyone. Let's get some energy in the room. Good evening, everyone. Good evening. Lovely. Thanks, guys. We just need to pull through another 30 minutes or so, and then we're off to the races. All right. Let's do it. Okay, all right. Let's get cracking then. I found the topic actually very, very interesting. Building balanced portfolios with fixed income. When people think about fixed income, they always wonder whether or not it's just a defensive strategy, and they don't look at it as a value creation strategy. So let me start off with you, Santosh. What do you make of that perception problem as of now? I see a lot of push with regard to equities and various other asset classes, but this seems to be a little bit, the push seems to be lacking. What do you have to say about that?
Yeah, I think you coming on the fixed income panel is a big thing for me. So I'm sure the times are changing a bit. So I frankly think that I don't think there's a problem with the fixed income. I think there's more of a problem on perception of the equity side. Equity side, not fixed income. Fixed income is doing what it's supposed to do. But somehow this feeling of equity at all points of time, anytime you invest, you make fantastic wealth creation, is India's decade and India's century. I think that is something I think which is wrong. Fixed income is doing what it's supposed to do. People should realize that at all points of time, if you keep investing, you won't make decent returns. So time like this, when the last couple of years, the returns are a bit negative, that's the time I think it comes out in open. So we have a credit fund which I've been promoting over the last couple of years. And the first few years, the view was that 4 years, you are joking, fixed income? Equity is supposed to get you 20%. And I said, who told you that? He said, CNBC told me yes. So not CNBC, but I'm saying at any point of time you invest in 5 years, you make 20%. I think that is somehow slowly changing. Still a significant part of the investors who are coming in the market over the last couple of years, just to give some data, I think in mutual fund we have 6 crores unique investors. Guess 2020, there are only 2 crores. Okay. So from 1964, US 64 till 2020, we had 2 crores investors, which became 6 in the last 4 years. And therefore, these 4 crores investors have never seen a down cycle. I think they still can't believe that the returns can be low. I think over a period of time, I think slowly we'll see more appreciation for the fixed income side.
Okay, all right, interesting. And, sir, just to tell you about my personal investment, there is a proportion of my investments that goes into tension-free, risk-free, and hopefully my kids are happy someday.
Aditi, I'm telling you, please record this. Keep showing this on CNBC from tomorrow.
Okay. All right. Harini, let me come across to you. This digital push, that's something that could attract a lot of the youth, the younger folk. At times, when you go for a drink on a Friday evening with the younger folk, if you talk about some of this fixed income, the gradual returns, they'll be like, no, we are used to the 15-20%. At least that was what we were hearing a couple of years ago till this equity market started getting a little dicey. How important do you think is the digital push? And if you could come in with a comment even on the taxation aspect.
Nigel, see, the way I see it, equities have been culturally mainstream in India. Much longer before and much longer and much faster than fixed income, right? So, see, finally, both, whether it is equity product or a debt product, both are a set of discounted cash flows. But having said that, equities are very relatable, more emotionally compelling. Whereas fixed income, finally, when you see, you need to understand so many technicalities, right? More nuanced. So you have to know your credit risk, you need to know duration strategies versus accrual strategies, and we're not even talking about ISINs now. Somebody remarked earlier in one of the panels that in equity you have one ticker, right? In bonds you have hundreds, right? How do you even make sense out of it? Correct? And there's reissuance, and there are so many things to be understood. So I think the learning curve itself does delay adoption. So this thing that you're talking about, I think there's a learning curve to be solved for. And of course, most of the speakers remarked about it. And then there is this whole behavioral element, right? So these Friday evening, drinks that you're talking about, I'm sure people are swapping multi-bagger ideas. They're not really swapping screenshots of balance, bond portfolios, correct? Right. So this whole emotional connect. Whereas, what fixed income really brings on the table is predictability and stability and protection. And these are things that you appreciate over a period of time once you have seen some cycles, maybe older, wiser kind of thing, right? So I think, and the other thing that you talked about is how sensitive is it to taxation? I think extremely sensitive, right? Equity is when you're looking at a 12 to 18%, then, the tax is kind of psychologically consumed in the wealth creation journey. Right? That's not the case for fixed income. When you're looking at when you're staring at a 6 to 8%, every change influences your outcome over a period of time. And so we've also seen historically that between fixed income strategies, fixed income products, one over the other they are extremely tax sensitive. So that's another area. So I think the whole tech as well as the regulatory initiatives have taken this a long way. There is no denial of that. But the next stage of evolution for this market needs to come from investor education. And maybe, to take that step forward, like, the youth today, they'll have to be taught a little differently. So maybe we're looking at some biased-sized educational videos, we're looking at memes and maybe some simulated portfolios, right? Maybe gamify the bond maths. Okay. So there are things that you may have to think differently, like Mr. Mittal also said, right? If we need to reach Bharat, if we need to reach the youth, I think we're talking about a different approach.
Okay. All right. Vikas, let me get you into the discussion as well. Household savings, if you look at the fixed part of the portfolio, a common man would say it's more fixed deposits, but there's so much more, right? What is your take on that? Have you seen a bit of a shift on that front from the fixed income portfolio? A little bit of move away from fixed deposits into other instruments?
Thanks for having me here. So I'll possibly try answering in two parts. One is structural, right? So we all know, right, that 60% of the household balance sheet was parked at fixed deposits, right? And then the savers moving to investors. That structural change, I think that's a tailwind that will continue with India, correct? So that meltdown from the fixed deposit balance sheet, right, of a household, that meltdown from the fixed deposit is going to continue, correct? The second part, I would typically say, is, right, that in a fixed income, there is, we've spoken a lot about tax, I'm not going to get on to that, but there is a magical number. The more you move towards the 7% post-tax, 8% post-tax, people are happy to trade off the liquidity for it. The more we are 4-5% of post-tax, then people will need liquidity for that product. I'm only speaking about the debt. Now, this similar psychology will play out at the household level. Right now, it's risk on, risk off, right? So, we've seen a good period of risk on, and that's what Santoshji was saying. Now, there is actually a period of risk off, and they're going to really see, right, what the debt product is going to make for me, inflation beating return. So the trade-off is liquidity versus the post-tax return. Point that I'm trying to make is, if the industry, the larger wallet share is going to come in with a more patient debt capital towards the 6, 7, 8% post-tax. Else, any other debt product has to be liquid. Now, if you see the journey from the meltdown which happened from the fixed deposit, I think mutual funds were one of the biggest gainer till like 23, purely because there was a tax arbitrage, right? And you were near to that at 7, 8% because there's 5% inflation, add up 2, 3% to fit. That's the magical number, right? And the mutual funds kind of, obviously, a lot of it moved into the SIP, correct? And I today feel the bond, OBPs, right, are offering that piece, which is the post-tax of about 7, 8%. Pick up a 10% bond, shave off for the average retail about 20%, it's still 8%. 11%, shave off 25%, right? It's still post-tax of 7 to 8%. So I think this OBP platform, right, which bought in this product directly, the sweet spot of that 10-11% is attracting. Eventually, we will have to start attracting the larger patient debt capital, which will, to my mind, eventually people will realize, right, that a 5% post-tax doesn't make sense. It has to be only a liquidity product.
Okay, got it. All right. Gopalji, let me come across to you. There is this notion that equity is the way to go. If I want to get richer, I'll put in a lot of money into equity. And some portfolios, they tilt too much into the equity side of things. Do you think some part of the investing community is actually ignoring that concentration risk, so-called concentration risk? Because we know that equity basically has given no returns in the last 18 to 24 months. It hurts a little bit, but yeah, that's the truth.
So I've seen this over and over again. I've been investing for 35 years in India. And personally, I've been investing now for 42 years. So you see a period of slowdown in equity markets. And first of all, it's not about equities versus fixed income, right? It's equities and fixed income,
asset
right?
allocation. Yeah.
For any long-term investor, we are not, there's a what's driving savings is increasing longevity, right? The average human being is living longer than their productive age. If you go back 125 years, life expectancy on this planet was 32. It's 75 today. If you go back 100 years, even 50 years, the average person was not working for, was almost, I'm sorry to say, was dying on the job. And today the average person lives far beyond their productive age. So balance and consistency is fundamental to a saving strategy. Thanks to what's happening in alternatives, the lines are blurring. So earlier fixed income was fixed income, equities was equities, but as many speakers have said earlier, there are some wonderful, exciting developments in fixed income that are blurring the lines between fixed income and equities. And we can talk more about this, but two areas are first of all listed investment trusts, and the second is private credit. And we can talk more about this, that both these classes of products, which are growing much faster than the broader fixed income landscape, combine features of fixed income and equities, and therefore offer new avenues for investors to capture features of both fixed income and equities, balance their portfolio, pursue long-term investment strategies. So I don't think first it's that question that is passé. Is it fixed income or equities? The interesting thing is that there are more avenues. There are some exciting developments happening in fixed income, especially at the alternative end, which combine features of both fixed income and equities.
Okay, got that. Santosh, coming back to you then. Now I'm a little nervous now because you're viewing me as an equity person.
You're treating me as a fixed income person. I'm not.
But tell me, in your interactions with various customers, clientele as well, and the investor community as well, what is the feedback that you have been getting, and how have you been seeing things evolving, particularly in a period where the so-called equity investor has actually been a little bit under pressure, no returns on the portfolio? So your interactions, in the last 18, 24 months or so.
I think a significant, so firstly, it's not as equity against debt. He said that it's equity and debt. At the same point of time, it's wrong to conceive that all points of time equity can make returns. That's the limited point I was making. India is a fantastic 4 trillion economy, 5,000-6,000 listed companies. I'm sure there are enough opportunities for someone who's expert in equity to make money.
Right.
And I have many, many friends who have made tons of money and will keep making money because it's a bottoms-up market and every point of time you can find options. But for a normal, simple investor, to believe that at all points of time you keep investing and making a lot of money, that is the misconception I'm saying.
Indeed.
Yeah. So I think it's just changing a bit, but it's not. Till now, I think the belief is that, earlier when I joined the industry in mutual fund, it was way back in 93, whenever the equity market used to fall, there used to be 10 calls coming up from investors saying that, what's happening? Can I speak to the fund manager? Over the last couple of years, the day the market falls, you get more inflows, right? And we proudly say that, wow, see, more inflows are coming up. But to blindly put money when market falls, I think it's not the best thing to do. And we have seen what happened to gold the last couple of months, 25% down, silver 30% down, Bitcoin 30% down, and gold, silver was supposed to be quote-unquote safe assets. It was safe asset till the time you were putting money to buy physical gold. after ETFs coming in, is not investment. It's like you're speculating on gold, you're speculating on silver. So I think a bit of that is coming up, but I think it will take a while, maybe one more year. So last 3 years, I think SIP returns are not negative. Maybe 4-5 years, if it's negative, then I think seriously they will say a post-tax of 8-9%. I think it's a fantastic, and 8-9% is phenomenally good. The only thing about currency may depreciate, and therefore in US dollar term it will look low. And one last point on the fixed income and on the equity risk, what market is not anticipating, a Japanese 30-year at 4%, a US 30-year at 5%.
Yes.
I think, if I recall correct, it was pre-global financial crisis, 2007. US 30-year was 5%. And guess what was the Fed fund at that point of time? 5.25. And when the global financials hit, they start cutting rates. Today you're sitting at 3.75. And it's upward sloping curve. That point of time was an inverted curve. Your Fed fund was for 5.25 and 30-year G-Sec was 5. Today it's 3.75 and 5 is again a steep curve. I think Japanese 30-year was issued, I think first time issued in 1999. From that date till date, Japanese yen has never seen a 30-year at 4%. And market is saying, forget about all that. The truth is happening, let's go buy more of equity. So I think macro fundamentals, a few things are changing. And I think it will be a testing time for the next 1 year when people will appreciate the 8-9% of fixed income tax-free returns.
Valid point. Harni, coming across to you then, in terms of allocation strategy, what would your view be at this juncture, with the kind of yields that we're seeing globally? As Santosh said, that we are seeing rising yields globally. And yet, people are still not too concerned as of now, but it could be providing an opportunity in itself. So comment on that.
I think, Nigel, asset allocation, there are a lot of textbook prescriptions, right? So, but I don't think any of that really works in the current context. And as we go along, it works lesser and lesser, really. Santosh made this point today about how we are seeing US yields behave, how we've seen Japanese yields behave. Who would have thought? Most of us come from we all our life, working life, we've seen a very different regime. Correct. Similarly, we've seen very different cycles in the real estate segment. We've seen different cycles in the precious metal segment. Now, if you see, a basic risk diversification strategy, even for a retail investor, would be that you have to have some overseas investments in your portfolio, right? So precious metals, overseas investments. And another thing is, a typical average, since we're talking about wealth management here, so a typical average Indian household, a lot of their net worth is primarily tied up in a single illiquid residential property, which is for consumption. So, right, and in terms of life stage, the additional investment avenues coming much later in your life cycle. So I think we're talking about no one prescription, right? We're saying that the most sensible thing to do today and going forward would be to have enough allocation, enough diversification, and to look at fixed income, say, as not as a low-yielding, diversification of your portfolio, rather than something that enables you to make your other asset avenues work in the long term, right? Because that gives you the safety bucket, which makes you capable of holding out your equity or holding out your real estate or whatever else it is that you've invested in. So I think that's the way to look at fixed income today.
Okay, all right. Vikas, coming across to you, in terms of credit quality, duration risk as well, do you think enough attention is being given by investors today, on that front? And what more can be done, in terms of making the investors more aware of, the various avenues of the market?
Okay. So, I think, they're going to take time, right? Essentially, the current market is a little more yield-focused market. Correct. Good part, and we've seen some earlier panels, right? At least the credit hygiene, the credit quality of the corporates and the financial services seems to be good at this point of time. What it gives a confidence that they are possibly can absorb a little more higher risk. How it pans up, we all don't know. At least I don't know how it's going to pan up. But are they capable to absorb? I think that I feel right that they will have a capability to absorb. Now it eventually then boils down to a right structuring, correct?
Right.
Yes, I think the entities which are facing the retail, which are selling the bonds, have to be a lot more mindful of what is the credit they're taking to the market. Correct? Expecting this from the retail, I think it's too immature at this point of time. So it has to be the other way. Right? It is if whoever is facing the retail and taking those bonds, right, have to be a lot more mindful of what credits are they taking into the retail. That's one. Correct? Today, if I only speak about the retail, I don't think so. They understand too much of duration, because a large part of money typically still going in high yield, which is in any case about 2 to 4 year kind of papers. Correct? So they are looking at more like an income generating hold to maturity asset. Correct? So they've yet not seen the duration impact, very frankly, right? Because a lot of the bonds did have a yield compression as well, and that's factually, right? But last 1.5 year, right? It's like structurally equity never saw downside, right? Yield compressions have already happened, correct? So one, to answer, at least the retail, if I only speak about the retail, it is more on the industry, correct? For being mindful of the credit. Duration, I don't think so it's too high a risk, because there's still a hold to maturity mindset which is coming in, because eventually they're coming in for the yield, correct? But you see this in the private credit, right? That's happening in a big way, right? The credit funds have tanked up a good amount of money over the last 2-3 years, and that's all patient capital which is coming in, right? So that means they know it's locked in, right? And the AUM is going up, right? So the mass affluent, I think they understand it better. Correct? And that's why we see the credit funds typically picking up from the AUM. Retail, I think I'll put it more on the industry, the entire ecosystem, that they will have to be mindful of what they take to the credit retail.
Okay. Got it. I think we have a short chat, but Gopal, you had mentioned at the start of the chat that it's both, right? It's debt and equity. So given the challenges, given the opportunities as well as of today, if you had to put it into various buckets, what would the asset allocation strategy be as of today? A very, very rough number.
Well, I don't think you can give a generic asset allocation strategy for anyone, but the good news is, again, like I said, the lines are getting blurred. But let's take a step back. The average person who retires today sees a drop in their quality of life at retirement, right? You move from downtown to uptown, or you move from a tier 1 town to tier 2 town, or move from a larger car to smaller car, from X number of bedrooms to X minus 1 number of bedrooms. If you want to prevent that, you need equity-like returns in your portfolio. And thanks to what's happening in fixed income, equity-like returns are now possible in fixed income portfolios. We've seen that over and over again from speakers today. We've heard that. Take listed investment trusts, for example. 7 years ago, there were 0 investment trusts listed in India. Today, there are 29. And this number is only going to grow. And if you look at the returns that listed investment trusts as an asset class have delivered, they are clearly capturing equity-like returns. There is an equity feature to the underlying risk, right? Similarly, when we talk about private credit, which is part of alternatives, private credit in India is really small today, right? It's less than 1% of the GDP. In India, we tend to often compare things with what's happening in the US. In the US, private credit is 6 to 7% of GDP, but private credit is growing at 2x the rate of bank credit. And why is private credit growing? Private credit is growing because there is a demand for flexible financing, which is no longer met by banks, right? We are big investors in banks. We know what's happening inside banks. And there are certain classes of risk. Take BBB, for example. Take infrastructure under creation, for example, which banks are redacting, right? So banks are moving away from BBB. BBB by nature needs flexible financing. And that flexible financing is coming from private credit. And what private credit does in return, it extracts an equity optionality and therefore can deliver an equity, not equity return, equity-like return. Of course, private credit is available only to accredited investors. There is a market failure in private sector fund of funds. I hope And I'm sure that will be addressed soon. So the average investor might be able to access private credit through private sector fund of funds. But taking a step back, broadly speaking, the innovation in credit, private credit, listed investment trusts, is helping investors capture equity-like returns with the benefits of fixed income.
Well said, and I think, we thank you for that. And thanks so much, gentlemen and lady, for joining in on this panel. Appreciate it.
Thank you so much. So India's financial markets are entering a defining decade, one that is driven by scale, innovation, participation, and immense economic opportunity. And as the country charts its path towards becoming a global financial powerhouse, the evolution of fixed income markets will be central to unlocking the next wave of growth, of capital creation, and investor inclusion. And few people have witnessed and shaped India's market transformation as closely as our next speaker. It is now time for an address that looks ahead with ambition, with optimism, and a bold vision for the future. Ladies and gentlemen, please welcome Ashish Kumar Chauhan, MD and CEO, National Stock Exchange, for a very special address titled Reimagining Fixed Income for a New India.
Friends, it's a privilege to be a part of the India Fixed Income Summit organized by CNBC TV18 and India Bonds. The theme, Reimagining Fixed Income for a New India, is not merely aspirational. It's an accurate description of where we stand, at a moment where the architecture built over the past decade must now be reimagined to meet the demands of the decades ahead. I've been told that I'm the only one standing between you and the dinner, so I will keep this short. The John Kenneth Galbraith once observed that finance is not the art of making money, but the art of making money work. India's corporate bond market must be made to work considerably harder than it has so far. India's financial system has historically been bank-led, with the bond markets evolving gradually through successive reforms over 2 decades. That gradual pace is no longer adequate. The investment demands of infrastructure, energy transition, and emerging technology require financing that is longer in tenure, broader in reach, and more diversified in structure than the current market provides. Widening the issuer base, deepening secondary market liquidity, and diversifying the investor base are not incremental goals. They are the conditions for these markets to fulfill its role in India's growth architecture. India's outstanding corporate bond market expanded at 13.6% per annum to rupees 59.1 lakh crore in financial year 26, growing faster than the bank credit at 12.1% over the same period. As a share of GDP, corporate bonds stand at 17.1%, up from 11.7% in financial year 12. Total debt fundraising reached 14.18 lakh crore in financial year 25 and 15.55 lakh crore in financial year 26. REITs and InvITs raised 24,471 crore in financial year 25 and 30,530 crore in financial year 26, the highest on record, with debt accounting for nearly 70% of their total capital raised. These well-structured vehicles demonstrate how long-term savings can be channelized into real assets at a scale, a template the broader bond market must now replicate. The headroom ahead is considerably larger than what has been captured. India's corporate bond market of 17.1% of GDP compares not so well with South Korea at 75.7%, Malaysia 54.7%, and the United States at 38.2%. Corporate bonds account for 21% of the overall domestic debt market. And while double-rated and lower issuances have risen to approximately 39.4%, signaling gradual broadening, the structural gaps in who issues at what tenure and through which investor channel remain defining priorities. Global debt reached a record US $348 trillion by December 25, exceeding 300% of global GDP, with both government and non-financial corporate debt individually crossing $100 trillion marks. The AI investment cycle is reshaping who issues bonds and why. In 2025, 9 major hyperscalers issued $120 billion of bonds, more than the 3 times their historical annual average since 2000, with consensus capex estimates of $4.1 trillion through 2030 for these 7 hyperscalers. For India, with its own ambitions in AI, advanced manufacturing, green energy, a deep corporate bond market is an enabling condition for the country's long-term development agenda. Financial year 26 marked a meaningful acceleration. Trade counts in debt market more than doubled to 28.4 lakh in a year, and turnover rose to 22.1 lakh crore. And all India average daily trading volume in corporate bonds now is around 9,558 crore, nearly 3 times the financial year 15 level. On NSE's platform, aggregate average daily turnover rose to 7,347 crore, with March 26 recording 8,359 crore, the highest in 9 months. Trades on the RFQ segment breached 2 lakh crore mark for the first time in April 26, rising approximately 2.1 lakh trades. On a single date, debt segment turnover touched 17,000 crores. The RFQ platform share of NSE turnover rose from 24.9% to 38.4% in financial year 26, reflecting a genuine shift in price discovery. It's early days, but we can see some green shoots. The participant story is equally significant. Individual investors account for 77% of total trade counts in the corporate bond segment on NSE's platform in financial year 26. Cumulative unique client registration have reached 12.7 lakh, with April 26 alone adding more than 3.2 lakh new accounts, nearly 11 times the pace of a year earlier. The 28 OBPP registered with NSE have collectively facilitated over 10,000 crore rupees in retail bond investments since the framework was formalized in November 22. With minimum face value for listed debt reduced to rupees 10,000, the barrier that confined bond markets to institutional participants is being systematically dismantled. NSE's role in India's fixed income ecosystem extends beyond domestic markets. As you know, NSE started in 1994, early 94, with wholesale debt market as the main market. Equities market came in November 1994. Through NSE International Exchange at GIFT City, which now commands 78.2% of market share of all debt listings in GIFT City, we are building a bridge between India's bond markets and global capital. In calendar year 25, NSE International Exchange facilitated 47,300 crore in debt segment instrument listings, and cumulative ECBs booked through GIFT IFSC have reached 4.79 lakh crore. On the sustainable finance frontier, GIFT City has facilitated over 1.2 lakh crore in green bond issuances. And in early 26, Sri Lankan Bank, DFCC, listed its bonds on NSE International Exchange and became the first foreign corporate entity to list debt instruments on NSE International Exchange. Allow me to go beneath the headline numbers because the structure of India's corporate bond markets reveals challenges that aggregate data can obscure. Consider who is actually issuing bonds. Of the 59.1 lakh crore outstanding, banks, NBFCs and housing finance companies together account for 49%. Financial intermediaries borrowing from bond markets to online elsewhere. Non-financial corporates remain underrepresented. A bond market that primarily finances the financiers is not yet fulfilling the structural purpose. Consider the tenure of what is being issued. The share of 10 to 20-year issuances has collapsed from 37% in financial year 24 to only 19% in financial year 26, nearly halved in 2 years, while mutual funds have reduced their corporate bond allocation from 38.1% of debt AUM in financial year 18 to 14.8% today, more than literally almost one-third. And consider the foreign capital that has chosen to stay away. India's FPI limit stands at 8.8 lakh crore, yet actual investment is only 1.3 lakh crore, a utilization of just 15%, down from 76% in financial year 19. That represents rupees 7.5 lakh crore of investable foreign capital not yet mobilized. The regulatory architecture supporting this market has been built with deliberate resolve over a decade. The EBP platform's threshold reduction to rupees 20 crore, the ICIN capping framework, and the RBI's revised credit derivatives framework of February 26, which introduces credit index derivatives and total return swaps with wider participations, represents a coherent set of structural measures. The Union Budget 26-27 adds a critical new layer. Honorable Finance Minister Srimati Nirmala Sitharamanji announced a permanent market-making framework for corporate bonds backed by access to funds and derivatives on corporate bond indices. She introduced total return swaps on corporate bonds and proposed a direct incentive of 100 crore rupees for single municipal bond issuances exceeding 1,000 crore. Market-making capacity, derivative hedging tools, the sub-sovereign market incentives together address the structural gaps that have historically constrained secondary market depth. It is worth noting that India's government bond futures were launched on the Singapore Exchange on 20th April 26, that is last month, by SGX, tracking FTSE Russell Asia Pacific Liquid Government Bond before equivalent domestic instruments are available on Indian exchanges. Introduction of corporate bond index derivatives was announced by Honorable Finance Minister Srimati Nirmala Sitharamanji in the Union Budget of 26-27, and NSE International Exchange at GIFT City is also awaiting approval to launch corporate bond futures and corporate bond index futures. IBC recovery timelines averaging 713 days against a statutory limit of 330 days continue to temper bondholder confidence. Over financial year 22 to 26, corporates have raised 60,000 crore through 193 public debt issues against 40.7 lakh crore through 7,800 private placements. Barely 1.5% of total issuance is now via public debt issues. Almost everything is now privately placed, although on exchanges. Until public debt issuances scale in number, size, and issuer diversity, the retail investor remains at the margins of India's primary bond markets rather than a genuine stakeholder in it. India's corporate bond markets have traveled considerable distance over the past decade, and the direction is right. Broadening the issuer base, deepening secondary market liquidity, resolving FPI participation constraints, compressing IBC timelines, and scaling public debt issuances are not separate priorities. They are interconnected conditions for a market that can credibly finance India's investment ambitions at scale. Niti Aayog has projected that India's corporate bond markets could reach 100 to 120 lakh crore, almost double current size by 2030. That is not merely an aspiration. It's a financing necessity for an economy with India's infrastructure agenda, energy transition ambitions, and Viksit Bharat 2047 commitments. The regulatory architecture is in place, the policy signals from the budgets are encouraging, and the institutional resolve visible in forums such as this one, is real. The roadmap is clear. What it now demands is coordinated execution. I thank CNBC TV18 and India Bonds for convening this conversation and look forward to the insights from today's sessions being presented and being sent to the policymakers. Thank you. Jai Hind.
Mr. Chauhan, could I request you to please stay back? Manisha, may I have you here? And do the honors. As we have partnered with Grow Billion Trees Initiative, all our esteemed panelists and guests are receiving a certificate that a plant has been planted in their name. Ladies and gentlemen, with that, we come to the close of India Bonds Presents CNBC TV18 India Fixed Income Summit powered by Mirae Asset Mutual Fund. What began as a conversation around bonds and fixed income has today evolved into a much larger dialogue about India's financial future, one that is shaped by innovation, accessibility, market depth, regulation, technology, and investor participation. As India's growth story accelerates, the role of fixed income markets in building a stronger, more inclusive, more resilient financial ecosystem will only be more significant. Once again, a big thank you to our presenting partners, India Bonds, powered by partner Mirae Asset Mutual Fund, our associate partners, AK Capital Services, Nippon India Mutual Fund, National Bank for Financing Infrastructure and Development, and our exchange partner, NSE. And a big thank you to all of you for being such a wonderful audience. You may now join us enjoying your night. Thank you.